Good afternoon, traders. This is your host, Sherry, and we have got a great lineup for you today. I want to, I've already done the sound check, and you should be able to see my screen of my speakers. Dean Ashley Bradshaw with Real Life Trading UK, Nick Lovelace, the Super Trader, Paul Lange, Disciplined Trading Strategies, and Price Headley of BigTrends. We're going to learn today about how to get steady and consistent returns in most market conditions, where you can enter and exit positions with an approach that's based on the price action and not an indicator signal. Technical analysis is all there is to make money in the market, not just the best, but the only. And you can also learn how we use weekly options to get the biggest bang for our buck with these high dollar stocks. That's just one bullet from each of our presenters. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find a recording of today's webinar. So we are recording. So if you have to step away or you have to leave early or you got here late, you can see the replay of this. Go to webinar. We'll send you the link so that you can watch it even today. And then by tomorrow, we'll have it up on tradersexclusive.com. And before we get started, we have to do our famous disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is an educational webinar. We do bring in speakers to show you different strategies, but it is training, so you have to test everything for yourself. Please take notes and write your questions down and hang on to them. Like if it's very urgent or you're confused, please do write it right then, and I'll do my best to get it answered. But if you wait until each presenter's finished, there is a question and answer period at the end. So I wanted to show you, we're going to be looking at high probability vertical spreads trading with Dean. And Dean is the CFO at Real Life Trading UK. He's what they call a serial entrepreneur with a background in mergers and acquisitions, who takes the casino feel out of trading by using fundamentals to set up high probability option positions based on math. I know a little bit of his background is 4 years ago, he and his wife sold their business in London and then moved to Spain. So he's 7 hours ahead or 5 hours ahead of me. And since then he's been trading. He started off with Forex, moved into some swing trading before settling into what he's calling credit spreads. Now, I'm going to want you to explain why you love credit spreads, Dean. Take it away, and I'm going to make you the presenter. Let's see. Change presenter. Yes. Are you with me? Okay, now let's see. Now you're self-muted. You need to unmute yourself.
Unmute. Can everyone hear me now?
Now we can hear you. Thank you so much.
Perfect.
We can see your screen. Yes.
Excellent. That's good. Anyone that knows me from my real life trading background knows that me and technology, we don't really see eye to eye. So I'm not surprised. I'm off to a fluff. But
you're doing great.
No, thank you so much. Okay, so yeah, I do trade credit spreads now. I have dabbled in, as Sherry kindly said, Forex to start with, and moved into some swing trading. But I've found the most consistent profitability using credit spreads or bull put spreads, which we'll go into today. But the reason why I like them is because the way I set them up, as you can see on my screen, they're high probability trades. And it maybe because I'm from the UK originally, I'm a very cautious investor. I like to make sure that when I'm entering anything, even if it's acquiring a business, is that it is quite sound. So I don't get into many trades well, in terms of like a day trader, but I do trade small trades consistently throughout the week. So just to point this out before we get started, Real Life Trading's mission is to enrich lives, and we do that with educating people on the stock market. We are currently, I'll go on to a bit about me and show you where we are. So here I am. I'm the co-founder of Real Life Trading UK. We also operate in the US, which is our main company, and I think our CEO Jeremy Newsom has been on this show many times. We're also in Australia, and we've just opened 2 branches in Denmark and India. So I've been trading full time for nearly 3 years, nearly 4 years now. I'll be 4 years in December. And prior to that, I did have 2 businesses, one in marketing and recruitment that I was fortunate enough to have from startup positions all the way through to sale. The latest sale that we did, I ended up working for the private equity firm in their mergers and acquisitions position. And what I had to do is work with the CFOs there and the legal teams to go and identify businesses that we would negotiate and then reverse them into our group. And I did that and sold my shares 3 years ago before I relocated to Spain. So I still invest in startups. I'm still an entrepreneur at heart. I do like to invest in ideas. So I do have a couple of startups that I'm currently involved with. And in my spare time, and I say spare time in inverted commas because I'm always working and always busy, I do consult on mergers and acquisitions as well, as is another passion of mine. So to answer Jerry's question, why do I trade credit spreads? So unfortunately, I haven't got any drawing tools here, but this is just a chart that's up in front of me. And the reason why I trade credit spreads is because it's a slightly different thinking, and it does help me as a trader. And I'll come on to why that it does after. But essentially, when you're looking to get into a trade, you have to get a couple of assets correct, a couple of facets correct in order for you to be profitable. So you have to time your entry perfectly. You have to time your exit perfectly, and your stop loss needs to be perfect as well. Because I don't know anyone here, but I've been very, very guilty in the past of having my stop losses far too tight to the point where I've been stopped out only for the price action to reverse and go in the direction that I originally thought, which is annoyingly and frustrating enough. So when I discovered credit spreads, the only thing that you need to think about is where is the stock or the price not going to go? So for example, on this in front of me, if we said like Tesla, which has just skyrocketed recently, right? Everyone knows that. But let's just say, you know, the 600 mark. If we looked at this chart and thought, well, that's not going to go down to the 600 mark, then all I would need to do is have my sell strike there. And as long as that price is not tested, then I win, whether the price goes up, sideways, or even down. So it can go down and I still make money as long as my price is not tested, which we'll go into later. So that's why I trade credit spreads. And then it might seem at this stage that, you know, what's the catch with that thing? And I will definitely touch upon that, because there is a catch somewhere. You know, you can't always take. There's always a give. So the purpose of why I trade this and who else is it for? So for me, the ideal person who would benefit from this strategy would be someone that wants to see consistent results, someone that wants to spend less time looking at charts. They want to have additional income, and they want to outperform the market and institutions. So, which is probably most people, right? And why should you listen to me? Well, the reason is because I'm probably the worst technical trader there is. So I see someone within this talk that are talking about technical trading is all you need to make money. Maybe I need to listen to that, because I am probably the worst technical trader. I understand technicals. I can see where the price action is going. I understand how to interpret volume. But for me, timing and all that was a struggle for me. So that's the reason why I found this strategy very rewarding. And currently to date, I am using this strategy and I am up 73% of my account. When I teach these strategies to my students, they're now outperforming me because they have the ability of having probably a better understanding of technicals than me, that they're able to outperform me. Some people even double their account within 9 months. So I do a lot of trading based on mathematical statistics. Now that sounds very like intimidating, but believe me, if I can pick it up, anyone can. It's like, you know, I've got the smallest brain in the room. So the reason why I like it is because it's very simple, it's very structured. You can just follow it consistently day in and day out. So here are some more reasons why. So the win rate percentage is normally around 80%. It can be up to 93% as we mentioned in the earlier slide, but typically it's around 80% win ratio. I quite like the fact that once you've mastered the mechanics and what to look for, it can take up to as little as 30 minutes per week to maintain. It does bring you consistent, steady returns in most market conditions. I was trading this strategy during COVID, and I think I ended up that year with about 40% return. So not too bad. I've got a long paragraph here, but this is like math-based options on the idea that we have like 70% chance of winning. So I'm just going to summarize this for you. Basically, what mathematicians and professionals have done, and a broker, which I'll mention later, who I have no affiliation with, back tested these strategies. These are not my original strategies. This is something that I stumbled upon, I executed, and it's performed really well. But statistically, if you follow these procedures, then 70% was the lowest win rate. And the catch would be, and I'll get it now because it seems too good to be true, and I don't want you to believe that, is that the risk to reward ratio is slightly skewed. You actually are risking more to make less, but you are consistently winning. But we'll talk about how to hedge against that so you can reduce your downside later on in the slide. I'm going to give you everything in this slide because I didn't really know how to present it. I'm going to give you exactly what I do from start to finish, and any questions at the end, please let me know. And if I can, if we do have time, then I would quickly jump onto my broker and show you what that looks like, how you set things up. So we've got a post here. Now, I am massively into my fundamentals. I must admit, we teach technical education a lot at Real Life Trading, but I'm hugely into my fundamentals, maybe because of my background. I've always been into finance and accounting, and when we're looking at organizations, income statements and cash flows and balance sheets just was exciting for me. Maybe I'm a nerd, but so I do like to make sure that a company is fundamentally sound before I invest. And here are my criteria. This is my criteria that I look for when I'm doing credit spreads. So first of all, they must be in the US and they have to have options because this is an option strategy. I don't really trade anything other than the US stock market because it's the biggest and the most liquid. I am looking for sales growth to be 20% or better quarter on quarter. I like to see that a company is generating revenue quarter on quarter. There's a lot of fundamentals that you can use, but for me, you can't hide away from sales. As long as a company is able to generate sales, then they've got a chance of staying alive in current market conditions. Next slide. I do like to see that the earnings per share, again, is growing quarter on quarter. Return on equity of 10% on better, and I really like this fundamental here, and a lot of people don't really understand what that is, but return on equity is an insight to the management. It's how can they use shareholders' money to generate profit. So you'd like to think that they can generate 10% with all the investment they've got going in. So I like to see that when I'm looking at some fundamentals. I generally like to see that the majority of analysts are positive or neutral. So I want to see that they're thinking this is a long-term stock or a company to invest in. I don't really know why, apart from maybe it's like herd mentality. I don't know, safety in numbers, but I just like to know that it's got the vote from the majority of analysts out there. Now the next number, which is number 6, I do, full disclaimer, tinker with. I do tinker with. This is giving you the optimal performance. So I like to see that the average daily volume is around 2 million or better, but I do tweak that. So sometimes I will go down to 1 million. Sometimes I even go down to as low as 500,000. It depends on how much I need to make from the market in that day. If I've got bills to pay, etc., then I will tweak with that. But ideally 2 million and more is enough. I like to know that the price is above 30, and that's because you get better premium when you're selling credit spreads. And when I mean premium, you get paid to do this strategy, right? So this is when we come to what the downsides are. I'll show you what that is, but you get paid to do this strategy. Think of yourselves like an insurance broker or an insurance company. You get paid premium until someone puts in a claim. So that's why I like this strategy also. And then point number 8 is I don't like to trade if there's been terrible earnings or if there's been a miss in earnings within the last 2 weeks. So if the company's had earnings and it hasn't reported anything positive, then I will let that alone for 2 weeks. I won't touch them. Or equally, if the earnings is within 2 weeks, I probably won't trade that either. and you can use things like Earnings Whisperer to find out when earnings are. So next is my technical analysis, which isn't, I can say that with tongue-in-cheek, because it's not much really that I look for in terms of that. The main point is I like to know that the company that I'm looking at is at least 10% off of the 52-week high. So the reason why I do that is because I don't want to do the newbie strategy and jump on a price action and getting at the top. You know, no one wants to get in at the top, because the next thing that happens is it sells off. So I like to know that there's some room there before I trade. So I'm not buying at the absolute top. I also like to filter through my stocks to see that they're trading above the 200 simple moving average on the daily. So we're seeing a nice bullish trend with a 10% drawback, meaning there's a good company at a discount, and that's the main thing, right? To buy good companies at a discount. I normally set these trades up on the hourly chart. And again, it's just what I was taught. I like the hourly chart. I think it does give you a good insight to what's going to happen. You know, so I use macro time frames to start with, weekly, and then the daily, and then I'll zoom into the hourly chart in order to set up my trades. And that's basically it when it comes to my technical trading. As I said, I try to keep it as simple as possible. What I then do when I'm on a chart is I will put the 200 SMA on the hourly chart. So I like to see where it is on the hourly chart. And if it is below the 200 SMA, then that's a good opportunity for me to take a trade. And the reason is because if you can remember rightly, I've got the 200 SMA that is, the price is above the 200 SMA on the daily, and then on the hourly, I want it to be below. And that's something where we call the value zone, because logically it should mean, and I say should in inverted commas because nothing is ever concrete in the stock market, right? But what that should mean is on the daily, it's above the 20, and now it's dropped below the 200 on the hourly. So inevitably it should spring back above, and that's what we want. We want the price action to go up in order for it to get further away from our sell strike, in order for our contract value to go up, and in order for us to take profit. If it's above the 200 on the hourly, then I tend to wait and not trade. Let's go on to the next slide. Okay, so the details of the trading. So this is the most important part now. This is where the math come into it. And again, these have been tried and tested by professionals and institutions, and they're working really well for me currently, and have done for the last few years since I've been trading these. So I use Tastyworks, well, it says Tasty Trades here, but it should say Tastyworks. Tasty Trades is a good educational platform. I have no affiliation with them, so feel free to go and check them out and sign up. But they have a metric called IV rank that measures the volatility against itself. And I normally sell when volatility is high, and I buy back when it's low. So when I set up my two-legged spread, I normally sell my strike when the volatility is high, and I will try and buy back when it's low. This is the reason why I do that, is because it gives me good premium. Because if you can imagine that when we're selling our puts, the people that are buying them are the ones that need protection, because they're in a bullish trend that is now having a bit of a fade, and all these institutions who have billions of dollars invested in that stock are starting to get worried. So they start to buy puts, and they're the people that we're selling to. And when we sell them, we get paid for that opportunity. So we'll go on to that later, and sort of the metrics that work well with that. And this is just literally, if you don't have it on your broker, IV rank, I'm not sure if that's strictly to Tastyworks, but you can use IV percentile or IV percentile rank. That's very similar. Equally, if you go on to barchart.com and type in the ticker symbol, it does have IV rank on there also. So this is the key metric. If the number is above 30 in its IV rank, then I will set up a credit spread. If it's between 20 and 30, then I am careful. I'm very careful. I could still take it if I like where everything is on the chart, and how confident I'm in that company that they're not going to hit my sold strike. And if it's below 20, then I would set up a debit spread, which we were not talking about today, but that's how you can trade markets in both directions. But I can give it, if anyone wants to find out my debit spread strategy, feel free to reach out to me at the end. Cool. Next up is the liquidity check. So people always ask me about how do I value liquidity, because it's anyway, you know, it's one of these things, right? But liquidity for me is highly important, because you don't want to get stuck in a trade that you can't get out of, and you want to get fair value for that trade. So the two measurements that I use when I'm looking on the option chain is volume and open interest. So I like to see that there is between 50 and 100, the number of 50 and 100 in volume, but the main focus for me is the open interest in and around the money, because that's where we want to get out, right? So as long as there's open interest has a number of over 1,000 somewhere, and I will show you that on the broker if we have time, then that's okay for me. And then this one down here, point C, is I'm sometimes flexible with this, but I'd just like to see that the bid-ask spread is not doing something silly, and I like to see the bid-ask spread is less than 10% of the ask price. So that's basically that. So that's how I can check to see the liquidity is there. So once that's all checked out for me, so I found my stock by using my fundamental analysis. I've looked at the chart and that all adds well to me. The stock is in the value zone. I've gone through the liquidity checks. Everything's checked out. The next thing is, okay, how do we enter, which is probably one of the most important parts, right? So I normally take my expiration days anywhere between 45 and 60 days. The reason being is this has been tested by math. So this is where you give yourself the best possibility of your trade working out. So that's my expiration. And this is very important. So the strike price. So research has shown that a 30 delta will give you the best risk to reward. So that's 30 delta. So I try to aim 30 delta as like the bullseye. I have been known to trade as low as 20 delta, and I've gone to a maximum of about 35. I do feel that the closer you can get to the 30, then the better the strategy works. So I always try to look for that when I'm selling my options. And then position sizing. So how do you gauge how much to risk or how many contracts to buy? That's going to be dependent on your risk tolerance. From my recommendations for me is I normally commit anywhere between 3 to 5% of my net lick. And that gives me confidence in that. And another reason why I like credit spreads is that you have defined risk, as you can see here, because you've got built-in stop loss. So, don't forget you're selling the stock for a certain price and buying it back for another price, and you're just keeping the premium for that. So you're never going to lose more than you have committed to the trade, which your broker should clearly display that. But the trade-off, this is the trade-off. So with everything positive, this is the trade-off. So you have limited defense choices and you have cap gains. So what do I mean by that? Your defense choices are limited because there's not much you can do if the trade starts going against you. There's only three things really. And I will show you how I mitigate against that to give you the optimal performance. But you can either close out for a win, close out for a loss, or you roll until the next month. They're your only options when you're trading this type of stuff. And your gains are capped. So for example, don't forget we're selling premium. So if you get paid $1.65 per share, and in options, the shares come in 100, so you're paid $165 per contract. That's your upside. You're not going to get any more than it. So you have cap gains. So just so everyone knows, that's the trade-off. Do you want to cap your gains and limit your defense, but have a higher win ratio? And for me, it worked out a lot better when I was trading because I was a terrible technical trader. Simple as that. Okay, so here's just a rule of thumb when I look for premium. So I normally try to get a third of the width of the spread to collect in premium. And I normally only do a $5 wide spread or a $10 wide spread. So here are the numbers for that. So if I'm selling a $5 wide spread, then I'm looking to collect $1.65 to do that, to get paid on that. Now, if I was to set something up that I really liked and it was a $1.50, would that mean I wouldn't take it? Of course not. This is just the ultimate goal, and I try to get as close to these numbers as possible. And equally, if I'm doing a $10 wide spread, then I'm looking for $3 and order threes. So this is probably one of the most important things, and this is what I think revolutionized my trading, because everything else up to now is like, okay, it's quite basic, and it's set up really, it's just an easy setup. But once you're in a trade, what are your targets, and how do you defend if things go wrong? So there's a few things that I do, and again, based on study and high probability that has been back tested by machines for years. So as soon as I've entered in a trade, I normally set up a good till cancelled to collect 50% of the premium that I've already collected. So what is that? So if I've got $1.65, then divide that by 2, and if my price hits that, then I'm taking that and moving on. That statistically puts the odds in your favor. I normally will do something at 21 days, so I never let anything go to expiration. I always start to manage or do something with it at 21 days, and at 21 days, I'm either if it's not hit my targets that I wanted, if it's not collected all my premium, then I will either close out for a small win, I'd have a close out for a small loss, or like I said, I would roll into the next month. But I have one condition on rolling, which I haven't put on here, so I apologize. But I only roll if I can get a credit. So I only roll if I can get paid to do so. So I'll roll into the next month and then get paid to do so. And it's normally, I wouldn't take anything less than like 5 cents per share on that. So, but again, because what that does do, it just eats into your dollar cost average as well. And then, yeah, I do manage trades early if needed. So if my sold strike is tested before 21 days and I start to become in the money, then I will roll earlier just to give myself some time and trust my analysis that the stock is going to go up eventually or go sideways, but not it just come out of the money. So I do manage my trades earlier. And what's happened there, excuse me, it was all going far too well, right? Hold on, I've got my emails up, apologize, don't save, and I don't know how to go back. Hold on, there was one more vital bit of information I think we had there. I think it's this one here. Cool. Okay, present. This is actually second to last slide before I take some questions or try to show you my broker. I think I've got time. So yeah, the reason why I do what I just spoke about earlier, managing trades earlier and 21 days, is because it's a better to risk to reward ratio. You avoid assignment because I don't want to get put to these shares. If I wanted to own these shares, then I would just set a put and I would wait to be assigned. So I'm getting into organizations that I don't feel are going to go to zero before my expiration, and I don't want to own them. It's simple as that. I have a whole new strategy and a different strategy based on shares that I want to own. And it does increase your win rate because you're collecting premium and doing it over and over again. So the philosophy in this way of trading is trade small, trade often, and you trade consistently. And like I say, yeah, for myself, I've gone from being a really average break-even trader to the last 2 years being well within 70% this year. Last year was close to 60-ish. The year before with COVID, I was around 40, but I've got better at doing this strategy, and the more I do it, the more confidence I have in it, and the more I do, the more successful I am. So I'm happy to take some questions now. You can also got my email address if there's anything that you want to email to me. If not, then I'm happy to just bring up my broker and just show you like how I would set it up, and you got a visual for that because I'm a visual person. So I'm open.
I have one for you. It says, can you show us an example trade?
Perfect. Exactly. Look, timing. They say timing is key. So the best way that I'm going to show you, let me open up my broker, which is closed on me. Excellent. Just what I needed. Again, bear with me. I'm just going to have to come here. Okay, great. I can't get into it. Sorry, guys. This is not good. My broker's closed, and it's one of those terrible things that I have to find where my password is kept because it's not kept on this one. Bear with me. Hold on, I have to do that old school way. Let's just quickly come here, manage. And you can't see my passwords. Don't worry, I'm not that neglectful. Imagine everyone having access to this. Cool. I can come down here. Oh, it's open. As you like. Can everyone see my broker? Is everyone on there?
Yes, Tasty works.
Perfect, perfect, perfect. So let's pick AMD is normally a good one today. I looked at, so that's quite high. The high V rank up here is high, so it's 39. So it's above 30, which would mean for me that this is meeting the criteria. So December 17th would be 44 days. So normally I said 45 to 60, but it's close to 45. So that would be my expiration. I'm looking for the 30 delta. So here's all the deltas here. So where's the 30 delta? We have 27 and we have 37. So I'm going to go with the 27 just to see what that looks like. I would set up a sell strike there. And if we're doing, let's just keep it simple and do a $5 wide, and I'd buy that for 115. So again, you can see that when I'm doing a $5 wide spread, if you remember rightly, I'm trying to look for at least $1.65. This is a little bit low for me, $1.25. So I wouldn't take this, but the things that you're looking for is open interest. You can see over here on the left, look at all the thousands. So this is really the volume's there, the liquidity is there to get involved with that. And even the volume next to it, we said we're looking 1500s, highly traded. So that ticks all the boxes apart from the premium. And you can see when I said that there has to be some risk to reward, you are risking 375 per contract to only make 127, but you're not risking the full 375, if that makes sense. You are only allocating that. It's never going to go to expiration, so you're never going to hit max loss. You're probably going to get, if you do, about not even 30% of that. But this is a highly profitable strategy, so you do win more often. So say we did get involved with that, then what I would do is, as soon as I'm in there, I would set up a good till cancel close of 50%, which I can't really do because this is my live account. But that's how I would set that up. The other options that, and again, when I talk about value zone, let's just come here so I can show you on my trading platform. Let's see if we've got, so again, what I'm looking for on the daily chart, we're looking for the 200. Let's get AMD up so we know what we're talking about. So it's all similar. So I've actually got this is live, good information. I'm trying to pyramid into AMD. It's not coming down for me at all. Let me get rid of those real quick whilst we've got time. So my 200 on the daily is my red line. So if that's 200 and the price action is above, then that's good for me. Then I would go into the hourly chart, which is here. And I want to see where the 200 is on the hourly chart. So let's just quickly pull this up, 200. And if the 200 was above, so if the 200 was up here, then that would be, I would look to trade that. That's what I'd get into. Because on the daily, the 200 is below, on the hourly, it's above. That's what we call the value zone that we're hoping is going to bounce and go up. And as long as the price doesn't hit my sold strike, then you win. It's as simple as that. And I've got a couple of live ones open at the moment. These are a different strategy, but let me just, quickly, if we've got time, Sherry, I'll just show people what I mean. Just take TTD. So if we had,
you're good. You have until you have at least like 10 minutes left.
Okay, perfect. And then I'll stop for some questions. So
you don't have to hurry or feel stressed.
Perfect. Thank you so much. I appreciate that. So effectively, what I would do, you set up your call strike here. So I'm looking at this chart for TDT. I'm thinking, look, I don't think that it's going to come down to this level. So I would set up a sell strike there, and then I would buy it back here. And as long as the price doesn't hit this level, then you win. So it can go up, sideways. It can even come down to here. As long as it don't hit this price by expiration, then you get to keep the premium that you sold. And if we go back to the broker, if, for example, this is a trade that we're going to take, I wouldn't do because the premium is pretty low. but you get paid $1.27 for every share that you have, and you have to have 100 shares when you're trading options. And then I just basically would up my win rate by selling more contracts. So, you know, I would normally try and do like 5 or 6 contracts at a time, and then the risk to reward, well, your profit starts to increase. But again, 21 days, I would roll over. So I don't know if that answers your questions, but did that make sense of how I would set something up? Sometimes I don't make sense to myself, so don't feel like you can offend me. All good? Nice. Okay.
Folks, if you have any questions, we need you to pose them now. Dean's got a few more minutes to work. Is there anything in the presentation that you'd like clarification on? This is a rare treat for us to hear. I mean, I think this is probably a very different take on the way most people are doing things. And I see, can you look at the Disney chart?
Disney chart, let's have a look.
You must have seen Disney. Let's
get rid of some of these. Okay, and do they just want my analysis on Disney at the moment? Is that
do you have a specific question for the Disney chart? Yeah, what trade would you do? Would you do a trade?
So Disney, for me, from it looks like it's below the 2 moving averages that I like for a long-term trade. So it's below the 200 and the 100, which means it's probably in a bearish trade. I do have some pyramid levels that I like on Disney. Let's have a look on the weekly. So I'm waiting for on the weekly. I like it for more of a long term. So I wouldn't do like a credit spread on here, but I would do something which is called a poor man's covered call, which I teach in some of our classes. But effectively what that means is, for me, I would buy a long-term leap. So I would buy a long-term leap, and I can show you how I would set that up in a couple of minutes. And then I would sell short calls against it. And the reason why I do that is because, well, let's just show you. So this is grab Disney up. Disney, DIS. So what I would be looking to do with Disney, because I like the company long term, and I think they've got, Disney are never going to go to zero, right? So I'd be looking to go as far out as September, and I would be looking for, what's it trading for at the moment? 168. So the 165. I like to go one leg out of the money. So I'd be looking to buy a leap here. So I'm looking to buy that. This is why I like trading poor man cover calls with longer term stuff, is because it's going to cost me $16.17 to take this trade, right? So it's going to take away 1,600 of my buying power if I just buy one leap. But watch what happens when you start to sell a call against it. And I would sell a call within the same. Now I'm going back to the ball put spread strategy for the credit spreads. So now I'm going to sell a call based on the 30 or the 20 delta, somewhere in between. So it looks like this 26 is going to be the one. So remember this, my buying power is 1,600. It's going to cost me that. Now, if I sold this, see how it's reduced. And what I would then do is I would roll that, the sold call, I roll that every 21 days, and I collect premium every 21 days. And what that does, it eats into my buying power, which means my cost to take the trade starts to go down. And then once that happens, the more you roll it, the more premium that you collect, you actually end up not paying for the trade, and it's all upside when you get to 60 days. And I normally exit by 60 days. So I'll give you an insight into a strategy that I actually do mentorship programs on. So yeah, it's a good day for you guys.
Knocked that one right in there, didn't we?
Well, they say that the value of the question precedes the value of the answer, right? So someone asked me a very good question, so there you go.
You gotta know how to ask the right question, right?
Exactly.
Well, this is one of the major values of the Traders Exclusive live events, is that you can give nuggets of wisdom. People can do with them what they will, and hopefully it would be amazing for them. So let's see, I've got one more comment here. Graciano says, I like deep in the money bull call spreads. How does this compare to what you do with credit spreads?
Deep in the money bull call spreads. The only thing that it varies for me is I put probability maths in my favor. That's it, really. I like to look at statistically tried and tested data, and I just follow that religiously. So, you know, I do cap my upside, but I also limit my downside. And for someone like me who was a terrible technical trader, this just allowed me to be consistent every single month.
Perfect. Now, do you have, I'm looking right now for your link. You have an offer on your page that's pretty compelling, correct?
Correct, we do. It's good. So we're on reallifetrading.co.uk. I'll just quickly log on here. We're actually having we had a free week. We're in the middle of it now, so you could probably still sign up. I do a fundamental thing on a Wednesday. We have a special launch price, which is $59 a month, or $300 if you're going to do 6 monthly, or $595 for the year. And basically you get access to our global Slack network, which is 500 traders plus. We have official trades on there. We do have some complimentary coaching sessions depending on what package that you have. But effectively what you get for that is, hold on, I'll come here. So we do have a Forex session, which myself and one of our coaches, Joey Malone, do on a Monday. We talk Forex and currency. Josh Banner talks through some tech stocks and some swing trades. On a Wednesday, I look at fundamentals of companies. So people will give me a couple of ticker symbols and we'll go and look at the fundamentals of that company and decide whether we're going to set up what I've shown you today. And then on Thursdays, we have our two doctors, and they are two doctors. Like one's a surgeon and the other is a scientist of some kind. And they do their algo trading and how to set all that up. And I must say, because everyone is here today and we are doing a special thing at the moment, if you did come and join us, you get 14 days free trial anyway, but reach out to me and I can give you a promotional code that will give you 50% off of the rooms and for life, effectively. So you just pay 50% for the room. So again, it's more nuggets for everyone here, you know?
Look at that. And it's dean@reallifetrading.com, right?
Correct. Yeah, dean@reallifetrading.com.
All right, I put the link. Now you had a link just to your homepage in the stuff that was sent to me. So I didn't post that, but I noticed that you went to your homepage and you clicked memberships to show the levels. But on the homepage, you've got your free week too, right?
Yeah, okay. That's it. Yeah, so you can free week, which you can still sign up for, I believe. Yeah.
Yeah. So bottom line is, folks, I've put it into the chat, the link and Dean's email address, and you can go and ask him for that code to get you 50% off.
No brainer.
That's pretty amazing. Pretty amazing. So we're right on time. I really appreciate your presentation. I hope everybody will go and take advantage of this. Check it out. Get your free trial. Get your 50% off. And notice that you will be getting email from Dean probably either Friday or sometime in the beginning of next week just to remind you of what you can get. So perfect. I thank you. Thank you so much for joining us.
Thank you so much for having me. It's been an absolute pleasure, and hopefully I can come on here again sometime with a different math-based strategy.
I would love that, and I will definitely be in touch.
Perfect. Thank you, Sherry. Thank you, everyone. Thanks for listening.
All right, you guys have a good day. Thank you so much for, you know what? You stayed up late for us too, so. Thank you.
Thank you so much.
All right, here we go. All right, show my screen. Can you see my screen, everybody? Because I need to remind you that if you have to leave early and or you came in late, you can get the recording of this. You'll get an email from GoToWebinar telling you the links. You could watch it even today. And by tomorrow, it will be on tradersexclusive.com/archived webinars. So our next speaker is here waiting in the wings, I see. And what I want to do now, I'm going to just move past these. Usually I give you a little tutorial on how to find them. But honestly, go to tradersexclusive.com/archived_webinars and you'll be able to see all of our previous webinars. Next up, we have Nick Lovelace of the Super Trader with how to follow the smart money and skyrocket your profits. He is the founder and head trader at thesupertrader.com. It's a website that specializes in using options and stocks to generate consistent monthly income, as well as long-term capital growth. Nick is also the chief investment officer of Alpha X Capital, or is that Alpha 10 Capital, an asset management firm for accredited investors. So let me just bring Nick into the presenter realm, and there we go. Hi, Nick. Are you there?
I am. Can you hear me? Can you hear me okay?
You know what? You're not muted, but I'm not hearing you.
All right, give me 1 second.
I can see your microphone go when you speak, but I'm not hearing you. Let me go back here.
Okay, can you hear me now?
Can hear you now. Can everybody hear Nick now? I'm pretty sure if I can, they can. So I've made you the presenter so you can, I see how to follow the smart money. And then do you like questions throughout the presentation? Do you ask questions and get responses?
We're going to be incredibly engaged today, so that'd be great.
I'm going to make you an organizer then. Okay, so you should have more menu so you can see when people have questions and are engaging.
And they will comment where now? Can you guys just let me know if you can hear me loud and clear? Okay, it's going to be in the questions area.
Yes.
Wonderful. All right, thanks, John. Awesome. 2 Johns, John G and John Grad. Awesome. Good deal, you guys. Great. Let's go ahead and jump in here. We're limited on time. I want to pack as much value in this as we possibly can. So we're just going to jump and dive right into this. So, all right, my goal here, and if this doesn't align with your goal, sorry, but hopefully I can contribute some way. So I want to go through what I think you will see is one of the fastest, most reliable ways for you to enter and exit your positions at the right time. So how many of you have ever had a problem where when you get into something or get out of it, it seems to do exactly what you were hoping it would do? You're just always behind. Anybody ever feel that way? Say aye. So John says yes. I'm sure that if we're all being honest, we've struggled with feeling like we're just a step behind the market. And so today we're going to talk a little bit about what drives the market, what's the force behind it, and how we can follow it to maximize our profits. So typically I like to start off this way and do some trivia. If everybody can find the chat here, and let me know, just say go. We've got a decent number of people here, so we're gonna do some trivia. I want to make sure that you've got the chat area up. Say go if you've got the chat area. We're going to play a little trivia called Who Is This? Okay, who is this? So who is this? Who is this? I'm gonna give a $100 Amazon gift card to the first person that can get this. You just need to email me that you won. All right, here we go. Lots of people go. Nope, it's not me. Okay, not me. Who is this? I'll give you a hint. Okay, this is in his voice. 8 years after starting a hedge fund from my dorm room, I had lost tens of millions and went totally broke. Anybody know? Anybody know? No guesses? Tudor Jones, good guess. Nope. Okay, here's another one. I lost so much money, I couldn't afford to make ends meet. I even had to borrow $4,000 from my dad until he could sell our second car. Warren Buffett, Andrew says. Tim Skies, or I think you meant Sykes, I'm not sure, but nope. Jamie Dimon, nope. Good man, real good guesses here. Okay, going once, going twice. All right, how about now? Anybody? Who is this? It's Ray Dalio. If you don't know Ray Dalio and you are involved in the financial markets, you really need to. He wrote a great book called Principles on Life and Work. I start off this way because you are following in the footsteps of a lot of people that have successfully navigated the markets before you. And if you're having struggles that are giving you results that are inconsistent, if you're consistently inconsistent and have trouble predicting, how things are going to work out for you, this is a problem that you really don't need to be struggling with, because it's kind of like the wheel, right? It's already been invented, and you don't need to reinvent it. And so I'd like to start off this way because there are folks that have gone before you that have already figured this out. Ray Dalio is one of them. Bridgewater Associates, let me just tell you a little bit about Bridgewater. So Bridgewater was founded in 1973 by Ray Dalio. He was 26 years old. Today, it has grown to be the largest and most profitable hedge fund in the entire world. Their clients are now federal governments and federal reserves, and corporations like Apple and Walmart and Google and McDonald's and city pension funds. Okay, but just to give you an idea, I mean, we throw around this number like our budget right now. We're talking about what, a $1.5 trillion budget. These numbers are thrown around constantly, and so 160 billion now is something that we've kind of become, I think, a little bit, I guess, used to that kind of numbers being thrown out. But the reality is that 1/10 of 1%, that's 0.001 of 160 billion, and you still have $160 million. So this is a fund, and I start off this way because it is a incredible story what he's been able to do over there. And although it's difficult to relate to these kinds of numbers, the path that he walked is a similar one that you're going to have to walk. And so as you look at and kind of take in what they've been able to do, you recognize that it's not always been charming. He lost tens of millions of dollars, went totally broke 8 years after starting in the markets. He ended up having to borrow money from his dad. And the way this happened was he took a bet and was wrong. You and I have done that. And if you're fortunate, you haven't lost everything, but you may be struggling and have been at this for quite a long time. You ended up expecting the market to go into a depression in 1982, shorted it, and we ended up being in a long bull market. He said, I was dead wrong. The stock market began a big bull run, and over the next 18 years, the U.S. economy enjoyed the greatest non-inflationary period of growth in its history. My experience over that period was like a series of blows to the head with a baseball bat. Being so wrong, and especially so publicly wrong, was incredibly humbling and cost me just about everything I had built at Bridgewater. You may have found yourself in a similar situation that you can relate to, feeling like the market just keeps on beating you over the head with a baseball bat. And I start this way because regardless of where you're at or how long you've been at this, there is a path forward for you. And recognize that I love what he ends on. He says, my crash or failure was one of the best things that ever happened to me. I saw that to do exceptionally well, you have to push your limits. And that if you push your limits, you will crash and it will hurt a lot. You will think you have failed, but that won't be true unless you give up. So let's go ahead and move forward with that kind of spirit of our discussion, that regardless of how long you've been at this, you can get this. And I want to share with you a way that I think will radically simplify the process of finally getting the consistency that you're looking for. Okay, so the principle of what we're talking about here is this. You and I are really after one primary thing. We've got this chart, okay? And what you and I want to know, we want to know when these peaks and troughs are going to happen. We want to know when it's going to stop going down and when it's going to stop going up and when it's going to go up and break out and then go to other levels. That's what we want to know, right? Okay. And we've got, if we look in any one of our brokerage firms, we've got thousands of hundreds of indicators at least, that attempt to do that for us, right? We can come over studies, and there is a study for just about every single thing that you can imagine. And for my engineers in the room, you've learned how to create your own studies and do all the, okay, that's what we're attempting to do with almost everything that we utilize, is determine what the market is going to do, when it's going to do it, and how I can be on the right side before that happens. So what I want to invite you to consider is a better way. And that better way is understanding the forces that move the market and following them instead of using things that lag the forces that move the market. What I'm talking about is what we sometimes refer to or have heard referred to as the smart money, okay? The smart money, we call it smart money because they seem to do nothing but win and take everybody's money. And so it's a little bit of I think, term that we don't really understand who this is or what this is. But the reality is that there is a force behind the market that moves the market. And if you will learn to follow them, you will find that this gets really, really easy. So who's the smart money? So the FINRA, our regulatory authority here in the financial markets, the Financial Industry Regulatory Authority, they define you and I into two categories: non-professional and professional. This is on their website. Non-professionals, according to the FINRA, their buying and selling generally has no impact on the market overall in the direction that the market goes. However, professional designations, which includes pension funds, hedge funds, banks, insurance companies, other large investors, this is where the big volume comes from in the markets. They count for as much as 70% of all volume, and because of their dominance, their activity is what leads to sustained big movements in the overall market. And so the first principle that I just want to highlight here is that you and I, we're small fish in a very big ocean. And if you know how a guppy protects itself by hovering next to the great white, you and I would do well to do the same. Professionals, these big institutions, they make up 70% of all the volume. That's a key detail I want you to just file away as we have our discussion today. And because of their activity, that's what leads to big movement in the market. I'm going to show you some actual numbers real quick. This is me. I'm going to fly through this. These are kids. We've got 6 kids. I love everything outdoors. And I attended Brigham Young University after going on a church mission for a couple of years. I am the co-chief investment officer at a hedge fund called AlphaX Capital. We manage assets for accredited investors. So basically, we make rich people richer over there. And we created a retail firm that basically we enable those that aren't accredited investors to be able to have access to the institutional grade systems that we've created over here for our clients. We provide access to those self-directed investors over here so that they can have something that leads to predictable outcomes instead of random outcomes. All right, so how do we get in and out of positions at the right time? By following these big institutional participants, okay? So although what I'm gonna show you, you probably aren't going to end up, doing what, a firm like JP Morgan does. Look at JP Morgan's Investor Day results. So this was from an Investor Day. Obviously, JP Morgan is a very large corporation. Part of their business is trading. And if you go to page 12 in their Investor Day packet, this is where they detail the revenue generated from their trading businesses, okay? And it's just insane, all right? Remember, these institutions make up 70% of all the volume. Look at this. This is a 5-year period of time. And remember, there's what, about 252 trading days in any given year, right? So as we consider the data here, look at the number of losing days where JP Morgan's revenue came in below zero. They had 7 days this year and 2 days that year. We're talking about a total of 9 losing days out of over 1,300. Radical consistency, folks. Okay, radical consistency. Look at their revenue generated from on their average daily revenue. This is in the millions, 69 million, 72 million, 67, 70, 80. And it's not like they have big years and they have small years. It's their activity isn't up and down, basically erratic. Okay. So as you look at these outcomes, I just want you to recognize that this is a science for these firms. This is not something where they are going and trying to figure this out. This is absolutely predictable. And it can be for you as well, but nobody's going to sell you the ways that these people are operating. Firms that move the market, institutions that are really the ones that move the market, they don't have subscription services to their trade ideas the last time I checked. And so how do we effectively follow these folks? Because clearly they've got it figured out. If they don't give us access to their trade ideas. Well, one way we do this, and you've heard of this term, I'm sure, before, it's called unusual options activity, okay? Or we can look into, large purchases that these firms are making. There's websites specifically dedicated to giving you access to the information. All these funds, they have to report on the positions that they take. If you have over $250 million under management, they have to report the positions that they're taking. Our hedge fund doesn't yet have $250 million under management, and so we don't have to report all of our positions. But let's just look at Bridgewater Associates. We can come over here and we can see their portfolio. They have to report this on a quarter by quarter basis. And this is one way we can follow them. we can come in here and see, all right, what is Ray Dalio, the top hedge fund manager in the entire world, most profitable manager in the entire world? What is he doing? I want to follow him. Well, his second largest position is Walmart. Well, maybe he knows something I don't. I'm going to go get me some Walmart. Okay. Or we may subscribe to things like, unusual options activity alerts, where essentially we are looking for big purchases from these big institutions that move the market. So for example, here we've got somebody buying, literally just a couple of minutes ago, somebody buying 6,600 call options on EEM, Emerging Markets ETF. Okay, so we come over here, look at EEM, and we say, well, wow, so whoever this was, I mean, if I just do the math on this, and we calculate that, they came over, they paid $2.43 per contract. Okay, so $2.43 per contract. And they purchased 6,600 contracts. So somebody spent $1.6 million on call options in EM. I think that we would all be correct in assuming that this is probably one of those large institutional participants, these professionals that move the market, right? We'd probably be correct in making that assumption. So we may find ourselves coming over here and, well, they must know what, something I don't. So I'm going to go get bullish on EEM, or I'm going to go get bullish on Walmart because I can see that Ray Dalio and his firm have a lot of Walmart. If you've done this or done anything like this where we're trying to directly observe what these big institutional players that are radically consistent, I mean, why wouldn't you follow what they're doing, right? It is almost a complete 100% predictable science. Really, it is for them. Why wouldn't you do this? The reason why you cannot directly follow them is because we don't know why they're doing what they're doing. We don't know if Walmart is part of a hedge to some other strategy that is really their intentional, and core holding. We don't know if we look at this large position in EM, we don't know if they bought to open these call options today or sold to close them, or bought to close them, meaning that they were short call options up here and they just bought to close them down here after hitting a profit target, because you can short call options as well. Even if they come and tell us their agenda on a talk show like CNBC, there's really no way for us to truly know their intentions. So we cannot directly observe what these institutions are doing because we don't know what their true intentions are. But what we can do is we can indirectly follow them. So let's talk about how we do that. Remember, these guys are radically consistent to the tune of, it's just an ATM for them. They just pull out millions and millions and millions of dollars a day, and they hardly ever lose. I want to participate with them rather than against them. So how do we do that if we can't directly observe what they're doing? Well, it's kind of like a black hole, right? I mean, here is a black hole according to an artist rendition. The reality is we've never seen a black hole. Yet this is an object that is the largest known object in our observable universe. The most powerful object as well. It eats light, okay? Nothing escapes it, yet we can't see it. And I really like this analogy because that's very similar to the forces that move the market. Here they are, they're these big black holes, and our portfolios can't escape their grasp. everything that we do is generally in opposition to them. And if it's not, eventually we will do something to change because we are skeptical and we change our behavior, and they take it all back from us anyways if we do go on a winning streak. So it's kind of like this. Astronomers, they say on NASA, they say astronomers are able to detect black holes by watching for their effects on nearby stars and gases. So we can't directly observe this massive force and detect where they're at. We've got to indirectly observe them, and that is how we can effectively participate and follow along with them, and therefore turn our results into predictable outcomes. And you don't have to subscribe to anything to do it. So this is where you may want a pen and paper. There are 3 effects. Everybody with me say I. Everybody with me say I. Hubert, does JP Morgan buy order flow? Most firms do. Most firms do, but you know, that's just the game. That's not going to be something that. Okay, great. Everybody's with me. John, Hubert. Okay, let me know you're with me. All right, let's go on. So there are 3 effects that these big participants have. It's kind of like a big lake. When they move in the market, it leaves a ripple effect that we can detect. And so the 3 effects is what we're looking for. Now I'm going to introduce a term to you that is something that you're familiar with. It just may be a term that is new language, and that's the term auction of the market. When I refer to the auction of the market, what I'm referring to is the ebb and flow of price. Okay, this is the market. That's all it really is. It's an auction. And nowadays we don't really see that because it's all operated by computers, but essentially you have a certain number of things for sale and a certain number of things of buyers wanting to buy. And we show up nowadays on our platforms, and the computer program is constantly looking to align and balance the auction to where there is an equal number of buyers and equal number of sellers. So we always have imbalances where you may come in on a day and we have this number of buyers and we only have this number of sellers. And so, you know, inevitably what happens is an imbalance is created in the market, and the computer program that operates the ebb and flow is going to constantly seek to balance the market out. So on any given day, we may end the day with a more significant number of buyers and sellers. And so the auction of the market will go and seek to balance that out by finding more sellers to balance and equal out and satisfy the number of buyers. Okay, so the ebb and flow is what we call the auction of the market. And in the auction of the market, there are 3 profiles that get created, and these are the 3 effects that we're looking for. The first one is what we refer to as consolidation or price clustering. The second one is what we refer to as chasms or gaps. And the third one is what we refer to as vertical imbalances of price. Now, to understand and bring this together, remember, 70% of all volume comes from these large institutional participants. 70% of all volume comes from them. Okay, so they are also radically accurate, right? They're the ones that we looked at here, JP Morgan's results, where they have 9 losing days out of over 1,300. Their average daily profit is 69 million, and it doesn't vary much from that. So if we're going to follow, we also know we can't directly observe what they're doing, and effectively follow them. So the way that we effectively follow them is we want to participate where they're participating. So where do they participate? Of these three profiles that are created in the ebb and flow of a stock or any index or ETF or any other security, there is one profile where the majority, and I'm saying 95% of all of the institutional buying and selling happens in one of these profiles. So we want to follow them. We can't directly follow them. So we need to know, where do they do business? So of these three profiles, I'd love to see, which of these three do you think most of the transactions from these large institutions is taking place? Which of these three profiles do you think? A, B, or C? Go ahead and find the chat and answer for me there. We've got A, gaps. Keep going here. Okay, engage with me. We've got a large audience here. Put yourself out on the line and engage. Which one do you think? C? Okay, so here we've got two A's, one B, and two C's so far. And I think that if everybody was chiming in, that's probably about similar results that we would see. Okay, I don't know if you guys can see the chat here or not. I could probably take a little picture of it here. Here it is right here. Okay, so notice here we've got A, C, B, B, C, C. And then that's all the comments we got from a big audience. So wake up, people. But we don't know. You don't know. Here's the answer to that. Most of their activity happens in A. And this is why. First of all, so remember, these are big participants. 70% of all the volume comes from them. So why is it that most of their activity happens in A and not the other ones? The reality is because if an institution comes in and let's just say they want to purchase 50 million shares, there's probably not 50 million shares available right now. And if they come into the market and try and acquire all of what they want right now, what will happen is the auction of the market will go and try and find sellers to satisfy their buy order. So here's how it would go down. If they came in and they want to buy $50 million worth of this equity that's trading at $100, okay? What would happen here is there's going to be, well, let's just say they want to buy 10 million shares. They want to buy 10 million shares here. They come in, execute this order and it's trading at $100. Well, right at that very moment, there may only be, say, 100,000 shares available for sale at 100. And so what would happen is the auction of the market, Manohar said exactly, he said they don't want to raise price. And that's exactly it, okay? What would happen here is if they came in and did this, the auction of the market then would go look for sell orders to satisfy their 10 million share buy order. And so it would go up, 105, they may find another 100,000 between there and the $100 price. It would go up another step and they may find another 200,000 there and fill them there. It'd go up another bit. And they may find, you get the point, and on and on. And until this order is satisfied, what would happen is the market would rapidly rise and it would crash right back down to where it started within minutes. This is called unstructured activity. This is not beneficial to a large institution. They don't want to drive price up to have it crash right back down. Opposite to that is if they want to sell 10 million shares, If there's only 100,000 buyers and they hit the market with 10 million sells at this current price, the market would rapidly drop to be able to satisfy their sell order, and it would try to find enough buyers to satisfy their sell order, and it'd come right back up. They don't want to do that. They don't want to sell from here all the way down to there really, really quickly and have it go right back up. They want to sell in a way that gets them the best possible price on both sides of their orders. And so what they have to do is they have to be very just programmatic. They can't rush into positions or rush out of them. And so what ends up happening is when institutions are doing business, price clusters. So that's what you're looking for, is clustering activity. I want to prove that to you. So we're looking at a chart on Facebook. Facebook had earnings here. This is an intraday chart just to demonstrate, where volume comes in at. They had earnings. It was very positive. It shot up. Next day, it opened up 8% higher. Okay. Most of us see this phenomenon and think, well, they had good earnings and some computer came in and bought up a bunch and price went really, really high. But that's simply not the case. If we overlay what we call a volume profile, which puts volume on a horizontal axis, what we see is where the big volume came in. Remember, 70% of all volume comes from these big players. They're the ones that move the market. These little green volume nodes, they dart out. This is where your volume is. Earnings comes out, shoots higher. Look how thinly traded that is. And then we cluster. This is where your volume comes in. And then we go vertical. Look how thin volume gets. And then we cluster. Look at your volume. Okay. Clustering is where 95% of all institutions are transacting business. And remember, their results are radically predictable. I don't have time to demonstrate this to you over and over and over again to show you how insanely accurate this process is. But in conclusion, I will share with you one chart that will really blow your mind at how accurate this process is. Remember, their outcomes are predictable. So it must mean that their activity is predictable and that we can see some kind of a pattern between these clustering areas. I just want to pull up a 20-year chart. This process that I'm going to show you works on all time frames and will predict 95% of every single move in the market, big move in the market that's going to take place. This works on every time frame. So if we had more time, I would demonstrate to you how I've done this. But each one of these levels is spaced equally. This is a mathematical algorithm that allows us to operate at the levels where institutions transact business. And I just want to draw to your attention, over the past almost 22 years, every single major move, every wave, every top, every bottom occurs in this framework. Every one of them. You're not going to have a bear market outside of this framework. Look at the radical accuracy of this. Look at before we got locked down. Look at where we were. We were at, we call these auction zones, institutional auction zones. We were sitting right in auction zone. Look at where we bottomed, right at our auction zone. It went really, really, really quick, and look at where it stopped for 4 months. Really, really quick and clustered. really, really quick, and 3 months of clustering. Look at where we're at right now. This process allows you to know not if we're going to come into here and go all the way down to here, but it allows you to be on the right side of the market. We don't know if it's going to do this or if it's going to do this and just cluster and move on to the next one higher. But what we are able to do is structure appropriate positions based on moving higher into this. Assume this is going to resist, protect our equities, get into vertical bear call spreads. If it breaks higher, get out of the way and participate to the next zone. If we drop down into a zone, look at where we dropped in October, right down to our auction zone. And as we drop into zones, we assume they're going to hold. We don't know if it's going to break like this and keep going or hold like this and go back up. But we put on positions that will benefit from it holding, and if it breaks below, we get out of those positions and participate and look for lower levels. Somebody just asked me the question, how do you determine which levels are auction zones? I'm totally out of time, and this is something that I would love to demonstrate to you. I have another workshop where you can understand that process a little bit better. And if you want to talk about this a little bit more and see how this can apply to you, I'm telling you, this, folks, will give you radical predictability in your portfolio. It aligns you with institutions to where your results lead to predictable outcomes, okay? And that is what this could do. So if you want to talk a little bit more about this, and this is something that you can see and strikes a chord, and you want to look into a little bit more on how to do that, I'd love to show more to you. And so what we're going to do, and I mean, you just look at the results here. So this is one of our group members applying this process. He sent me this email. He said, this is the first thing in my life that I've seen that's truly too good to be true. Now, my biggest problem is I'm growing this account so quickly. I've got more tax to pay if I want to convert the account to a Roth. I'm currently generating an average of $50,000 a month. It leads to predictable outcomes, folks. And so here's how we can help. I hear Sherry on the other end.
You have 2 minutes. You're good. You're golden. Do you want me to post your link yet?
Yep, yeah, let's put it in there. So we've set aside some time. If you want to look into applying this more and looking into an institutional grade operation that leads to very predictable outcomes, we'd love to discuss that with you. Whatever challenges you've run into, we've seen it, we know how to overcome it. So what we'll do on this session is we'll work with you one-on-one to craft a plan to hit your income goals for the next year, whether that's $10,000 a month or whether that's $200,000 a month. And I know that sounds outlandish, but folks, the amount of money that's generated in the market is ludicrous. This is in one of my portfolios. This is trading one day, this process on the intraday time frame, not the monthly, but and this isn't that large of a portfolio. So whatever your goals are, we can help you craft a plan to integrate following institutions to finally hit them.
Hey, Nick, I got a question for you.
Yeah, go ahead.
On this right here, what size of an account should a person have to be working with you?
That's a great question. So all your problems will be solved if you finally start getting in and out of things at the right time. So the reality is I don't care how much money you have. That's your issue. Typically speaking, somebody's not yet ready to be in the market if they got a bunch of debt, or if they have, if they're in a very, extreme financial situation that is causing a lot of stress. And normally they need to have at least $10,000, but I don't care. The bottom line is you'll get more money if you are accurate and your outcomes are predictable. Perfect. So good question. But the cost, if you want to sit down and look into this more, we're going to do this for free. We've got 8 spots for you to book this, but here's the requirement. You must have already had some level of understanding of the markets, taking some training, and are still struggling to find consistent, predictable success. And if you take one of these 8 slots, show up for it. Don't not show up for it. If you want to explore this process further and look into having significantly higher predictability, go and book that slot. So, number one,
put the link in the chat.
Good deal. Awesome, awesome. So go ahead and do that. I think we've already got a couple of them taken up, and I think I'm totally out of time. Sherry, that was really quick.
I think this is fantastic. I sincerely appreciate you being here. That was a great presentation. Really. Thank you. And I hope you'll come back again sometime.
Yeah, I'd love to. And there's a lot of questions in here, you guys. I'll put my email in here if you don't want to hop on and chat. Again, this is free to do it if you want to.
Yeah.
But you can shoot me an email, your question. I didn't get to a lot of them, and I'd be glad to answer there. But yeah, it was fun.
All right, thank you. Appreciate that. Okay, everybody, please take note of that link and go and book yourself some time with Nick. And Nick, thank you so much. I hope you have a wonderful rest of your day.
My pleasure. You guys as well.
Have a good day. Bye-bye. All right. Wow. Great, huh? Okay, so we have our next person up. I am really happy to have Paul Lange back with us again. And I just want to remind you, if you have to leave early, you automatically get the replay link in your email later. And in the future, to listen to this webinar, you got to go to tradersexclusive.com/archived_webinars, and the replays are posted there. Paul Lange of Disciplined Trading Strategies LLC is here with us with chart lessons. He started Disciplined Trading Strategies in August of 2017. It's a site for traders and investors. He runs a very popular day trading room and also publishes The Long-Term Trader, which is a portfolio for hands-off long-term investors. He also provides a ton of free information on the DTS quote-unquote free stuff page and assistance to new people on his website, and the best seminar program for those interested. Paul is a very experienced trader investor with 20 years plus in the trenches every day. He spent many years at Pristine Trading as the senior instructor and trading room moderator before opening Disciplined Trading Strategies. And the concept is to, not to run a business, but to just have fun providing a serious place for traders, both new and experienced. Welcome, welcome to Paul Lange. I'm going to make you my presenter now. And come on. Are you there? Are you still muted? You're self-muted.
I am here. Hi, Sherry. Hi, everybody.
I can hear you. Thank you so much.
Let me see if I can get my let's see if we do it first time this time, Sherry. I always have a little nope, not such luck. I always have a little problem with GoToMeeting. We'll get it. Hang on.
It's just got extra steps than the Loom. With Loom you just have to choose to share your screen, but with GoToWebinar it's a little different.
Do you have my slide up there?
I do not.
Okay, hang on.
It did make you the.
Yeah, I have the ability here. It's just not.
Let me see. Let me see what people can see.
All right, hang on.
How many screens are you working with?
Two. I think maybe we have it here now. It's always matters to me to webinar is which monitor I'm on, and I never seem to get it right. All right, how about now?
Let's see if I can figure out what everybody else is seeing. All I'm seeing is Traders Exclusive Live Strategy series. Why don't you try unsharing and then share again?
Okay.
Nope. All right, hold on a second. I'm going to make myself the presenter again. All right, so can everybody see my screen at this point? Can everyone see my screen? It should say Traders Exclusive, 2:30 p.m. Chart Lessons, Expert Trader Paul Lange. Okay, thank you, Sarah. All right, now I'm going to try this again to make you the presenter. Yes. Okay, now you should be able to share your screen.
There's a different box up here now. This is going to work, I think. Got it?
Maybe I'm the one messing up here. Can you guys see Paul's screen?
I already took it down because you said no.
All right,
Me do
hold on.
individual window here.
I need to do something else here. I'm going to make myself
Let me
the
try one
presenter
other thing.
again.
Oh.
All right, I'm going to give it back to you in just a second.
All right.
I have my, I think I have done something here that, sorry folks, please bear with us. We'll be right there. We love technology. When it works,
I'll
it's
talk
great.
super fast. All right, here's the screen again. Let's try it. I don't know, Sherry. The little outline box is just pointing to a random spot on my screen. I'm not sure. Hang on, let me try it. Here, see if you can see it here.
No, it says it's waiting to view your screen. How are you choosing which screen it's going to look at?
Well, I've tried both kiosk full screen and in the individual window.
Oh, okay. So you need to, are you doing a PowerPoint slideshow?
Yeah.
Okay, so the slideshow is one thing, but then sharing your screen is another thing.
I know. I'm
So,
sharing the screen, but when you pick it, it's I'm picking the slideshow and the share. Yes, I know how to do that. It's just not working.
Oh, because when I go to share my screen, it asks me if I want to use screen 1 or screen 2 from GoToWebinar.
Do you have it now? I have this big purple outline up here.
I'm not seeing it right now, and everybody's saying it's saying loading, but mine says waiting to view PL's screen.
Okay, all right, hang on. Let me do what you just said. Hang on a second here.
Hey guys, once he hits his select, he's got to confirm. I think there's a second step
Another
where he
box.
hits share.
Yeah, and you got to confirm
like
if you're going to share your whole desktop.
Outline over what you want to share, and then you have to hit share. There's like some selection.
Right, yeah, I'm doing that. I'm doing that. It just is purple thing does not line up with where my, what I'm trying to show.
Gotcha.
One more try here. Do full screen. Is it better full screen or kiosk full screen? Does it matter?
Full screen would be best.
Here, how about this?
There we go.
All right. Watch how fast I can talk now. All right, hi everybody.
Hi.
Sherry, on my second slide here, if you'd post those couple links, that would be great.
On the second slide? Okay.
Yeah, I mean, I'll be talking about it. You'll figure it out, I think.
Okay.
So I always log in just a couple minutes before the last presenter, so I'm never really listening to anybody. But I saw somebody type, "Do you have any trade examples?" I'm going to have trade examples. So what I want to do, so you don't get anxious, I'm going to take about 10 or 15 minutes to run through some preliminary comments, and then we're going to look at some trade examples that kind of discuss what it is that I want to show you today. Before we get going, I want to just bring up a couple of things. I will discuss who I am more at the end, because if you don't like what I have to say, you probably don't care very much. So I'll show that slide for just a second, but we can talk at the end if you want to. And you can also get to know me by visiting the website and looking at the free stuff page, which I'll get to in just a second. And also, just so you're aware, I don't have any offers, deals, or any specials for you or anything like that. I'm just here to kind of talk to you today about what I do to make money and what I think is really the only answer to making money. I don't think there are any real shortcuts to the market. I've worked with a lot of people over many years, and I know a lot of the pitfalls. So I'm just here to talk to you today, show you some trades, what I do, and some examples of what it is that I do. I do want to emphasize that what I do is what I teach is what I do. I do it every day, and I'm in the trenches every day doing this with people. So if you like my personality, I'm a good person to learn from. If you don't like my personality, then you find somebody else. I think that should be true anywhere you go. And for some people, maybe you don't want to learn or you're not ready. I'm here to also help you if you want to try it on your own to some degree. And my website is set up with lots of information available to you. And there's also services. If you do want to just follow along, you can do that as well too. Many of you may not be ready. If you want to try and learn, that's just fine. But I do want to warn you, after many, many years of doing this and showing people, there are no quick fixes to learning to trade. There is no holy grail. There is no software program you pull up that just makes money for you, because we'd all be doing it. I'd be doing it. Everybody be doing it. Here's a quick slide I'm not going to stop on for more than just a few seconds. I just want to point out to you that I have been staring at charts for more years than I care to say, but over 20 years now. And I know how to make money. I know the pitfalls, and I'm in this perfect time in life where I'm just enjoying things, having fun. This is very much fun to me. I've been doing it a long time and have the time to work with people, help people. I'm actually bored most of the day, to be honest with you, most of the time. I basically trade the morning, some day trading. I look at stuff for long term a little bit, and I usually have the afternoon free. So I get together with people if you want to meet. Anybody listening to me, if you go to the website on the services page, there's a little thing up there you can request a time to talk with me for 20 minutes, whether you want to review some trades or whatever. Even if you're not a member at DTS, I'll gladly get together with you. Ding, 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 Sherry, free stuff page time. This is the home page, and if you click over here on the free stuff page, there is more information than you could look at in an entire week there. A lot of information, all good information. I claim it to be the greatest source of information, of useful information anywhere on the web. So go there and check it out. And when you do go there, you might be lost. So there's a section called the Hall of Fame, where members voted on the most popular videos in terms of past events. And here's a few other videos that are beyond the Hall of Fame as well. So start there and then work your way around as you'd like to. The information on this page is actually required by people who take seminars from me to know everything on there, because it's very good information. None of it is salesy. There's no selling going on. It's just good information everywhere, okay? When you go to sign up to be if you go to the free stuff page, if you would sign up to be a free member, and Sherry, that's the other link there, the free member link. There's no credit card. You don't have to give your name. You just have to give an email. That's for real. I don't want to email you if you don't want to be emailed. So when you unsubscribe, you'll never hear from me again. And also, you do not get subscribed to other places, sister companies. You know, I made the mistake on an email. Maybe some of you've had this. I unsubscribed to some, crazy place, and I got subscribed to 10 other places the next day. So I know that happens. You don't have to worry. If you don't like what you get, unsubscribe. You'll never hear from me again. And if you like what I have to say today, this Friday happens to be good timing. I'm doing what's called the Introduction to Mastering Technical Analysis course. It's actually the first course for people who take the seminar program, but I invite everyone to attend. You can attend. You just have to be a DTS member. You'll get an automatic invite, Again, there's no trick to being a member. You just give me your email and you're all set to go. All right, on with today, chart lessons. You probably got an outline of this here. I won't stop here because we're probably a couple minutes behind, but I want to just run through and tell you what is not the best way to make money in the market, but the only way. For 99.999% of the people, I'm going to guess that includes everybody who's here listening to me, and it is through technical analysis. If there were other things that were helpful or useful, I would use them. I would tell you about them. I would use them myself. I just want to make money every day, and anything that would be useful to me, I would incorporate. So when I tell you something is not only a waste of time, but actually detrimental, I truly mean it. And for some people, you maybe are at that level, you understand some of the things I say. Some of you may be kind of new to you, for me to boo-hoo fundamentals or news. But believe me, you'll get there eventually if you're not there today. I want to show you this slide before I show you, get into it too much here. This to me is one of the most important things to understand the market. I call it the three-legged stool. It's what I teach. The first step is superior technical understanding. And one of the biggest problems people have is that they never get a good technical education. You probably, if you've gone through and taken just a run-of-the-mill course or an average course or done your own research, you probably, if you're very good, you've probably learned just enough to lose money slowly. And maybe some of you can relate to that. You have to really get to understand the charts. I call it the language of charts to be able to make money from them. But even then, you may still have a problem. There's math and probabilities and the psychological and or experience aspect of it that's very important. And a lot of people boo-hoo that, but the psychological aspect is very important. It is what keeps people at a break-even state very often for a very long time. It's even more true if you are day trading. It's a little less of an effect if you're longer term trading. It's still an effect, but it's very much an effect if you're day trading. People oftentimes, when I work them, I'll explain to them, they're actually in a system where they're trying to break even. That's their struggle. Their goal is actually to break even the way they're trading. They don't know they're doing that, but that's the way they do it. Again, maybe some of you can relate to that. If you just heard me, maybe you didn't believe what I just said, but most people who learn technical analysis learn just enough to lose money slowly. You are actually taught in many cases how to lose money slowly, not how to make money. If you've heard phrases like get your stops to break even, you can't go broke taking a profit, these are all loser sayings. You should not be taught like a baby way of trading that's all safe and secure, and then somehow magically in a year you're going to change. Who's going to tell you how to change? I teach people how to trade professionally, all out, pedal to the metal, day one, because you have a safety net in place. It's called a stop. And when you start off, your stop is going to be next to nothing. You just learn how to trade with small money. And then when you are successful, you start advancing. But I teach you how to trade exactly the way you should be trading as a professional trader from day one. If you're interested in even learning that. Again, if you just want to try and learn on your own, feel free. If you want to follow along, long-term, short-term, you can do that as well too. Chart lessons. What I'm talking about right now is going to apply to all time frames. A chart is a chart, and it doesn't matter if you're an intraday scalper, if you like that term, on a 1-minute chart, if you're an intraday laid back trader on a 60-minute chart, if you're trading, swing trading on a daily chart, weekly charts for long term, whatever you're trading, it doesn't matter. The concepts are all identical. As a matter of fact, when I show you a chart, I could cover up what time frame it was, it wouldn't matter. The strategies are all absolutely identical. Thinking that long-term is different than day trading is silly, and that applies to everything, including fundamentals, news. Long-term traders, we don't look at fundamental stuff, we don't look at news. All I care about if I'm holding overnight is that I'm not holding a stock that could have a drastic move, like a biotech stock or something that's going up for approval. I don't want to be caught in something that could have a big move. But other than that, other than the holding overnight safety factor, everything's absolutely identical. Before we go through some trades, all I want to do is make money. If I had any other tool that would help, I would use it, and I would tell you, there is no such thing as a technical indicator that works. There is no such thing. There's no holy grail whatsoever. I know a lot of you think, well, gee, don't great companies make money? And of course they do. Good companies make money. It somehow translates to the stock price, but you can't make money from that concept. If you bought Apple 20 years ago, congratulations. You probably think the market is simple if that's all you've ever done. But if you're starting out today, what do you buy? Do you buy Apple today? Would you buy Apple today and just hold it for 5 years? What if it dropped 10% when you bought it? If Apple went up 5%, how much money would you make? These are all questions that are critical to making money in the market, and most people don't even really consider them or understand them. Everything is in the chart, and it's not that these other things are wrong necessarily. It's that they're built into a chart, and you can't see them in any other way. It's not what somebody says about a stock. It's not what the earnings were. It's not what the news was. It's the reaction to those above mentioned things that we care about. And that's what chart reading is all about, 100%. All we care about really, in essence, is we want to be long stocks whose prices go higher, period. We want to be short stocks whose prices go lower. What if you bought Apple today and it turned out today was the all-time high for the rest of eternity? What do you do? That's why we don't care about whether a company's great or not great. We care about making money. A couple other quick little tidbits before I get to show you some examples here of what I do. Correlation versus causation is a big thing to me. Correlation means things just coincidentally happen together. Causation means one thing causes the other to happen. News, earnings, all those things are not causational. They're just a correlation. Many get hooked on dumb things because it works sometimes. If you're trading long in a bullish market, you're likely making money even if you're using football scores as your entry criteria. It's not all that funny, by the way. Technical analysis always works. It doesn't mean every trade's a winner, but technical analysis always does its job when you understand it. What is its job? Is to incorporate everything out there and get the odds in our favor, show us the moment in time where we can enter with maximum efficiency, make the most money when we're right, lose the least money when we're wrong. That's what it's all about. We don't make the charts. I don't. You people listening to me don't. I'll guarantee you, you wouldn't be listening to me if you made charts. We follow the people who make the charts, the big money. And there's a lot of confusion about what that means. A lot of confusion. I'll leave it at that. So let me show you a couple of examples of what I mean in a sense, in a nutshell. I'm going to show you 2 long-term positions and 2 day trading positions. 2 long-term positions. Now, these are trades that were recent. As a matter of fact, these 2 I'm showing you were 2 of the 3 open trades just recently. One was Ford, and this is what I mean by technical analysis, kind of starting from the top down. Ford was taken because the weekly chart, I think, can you guys see my arrow here when I point? Yes?
I can see it.
Okay, you can hear me then. Somebody said they couldn't hear me, but I guess that was their problem. So we have a weekly chart here, and again, some of you may kind of recognize the concept going on or the strategy. That weekly chart gets my attention, but it's not good enough. That weekly chart then, that little area right in there, I have stocks that have weekly charts like that, and I have dozens of them, and I follow them for the long-term positions. I follow them for days or weeks, and I wait for what? I wait for something like this to happen on the daily chart, giving me that perfect little moment in time concept. Even that daily chart's not good enough for me. What I do then is I even come down, even for a long-term position I'm going to hold for months, I'll often come down to an hourly chart to perfect that entry, getting a great reliable entry that has good risk to reward and can make money on normal moves. And then when you get an exceptional move, it can make exceptional money. Ford made exceptional money. This is the long-term letter. I'm just showing you, this is something that goes out to many subscribers. And this was sent out on 9/21. And it gives you the concept, long over, short over, full risk, target 1. And target 1 and 2, you can see were hit on 9/23 on 10/8. Target 3 was just taken, and it was just taken. This is target 1. It was entered down here. Target 1, target 2, and target 3. I was taken out by about 7 or 8 cents the day before earnings. I was willing to hold this through earnings because I'm on my 3rd target and I'm up a ton of money. And I got taken out and I just let it get taken out. I kind of let it up to fade at that point. It went up another, what, nine risk units. So if you took $1,000 risk on this trade, you would have made $7,500 profit. Is that a good trade? Yeah, it's a really nice trade. It's one of the good trades you like to have. A second trade, similar time period, was IGT. I'm still in the last third of IGT. Same concept here. finding a weekly chart that has that perfect little setup, looking for a daily chart, and believe it or not to me, this is what I look for, that new low on the daily chart. When the weekly chart looks like this, the new low on the daily chart is not a short, it's a long opportunity. Finding the perfect entry on the hourly chart, which turned out to be right in here on that day, coming in, and here's the summary of it. Entry down in here, target 1, 2019 on 825, target 2, 2389 and 923, and target 3 is still open. So marked at yesterday's closing price, this is at a $15,000 risk per thousand, $15,000 profit per $1,000 risk. And that last part is still open. So that last part may go up higher. It may end up trailing out. I have a trail stop under now right here. So it's not going to give back much, and it could still run quite a bit higher. And if it wants to do that, that's great. So this to me is everything. It has nothing to do, I'm not even real sure what internet game technology does, other than I assume they make some kind of games for the internet. I know what Ford does, fix or repair daily, but I don't care what they do. I don't care what their earnings are. I don't care about the news. All I care about is that when I take out a long-term trade, I don't want to take it out right before earnings. Now, if I'm in the money enough, I'll hold it through earnings, because that's how you can make some nice profit. And both, and you know, that happened on a couple of the trades I was in, and it worked out really nice. But I don't get in before earnings when earnings are coming up, because that's just kind of a gamble. I want to see the reaction to earnings. So there's two long-term trades. And again, it's just this concept here of pulling the charts together and knowing exactly what to look for. Now, knowing what to look for, I have to tell you, that's not something that you learn in a 2-hour video. It's something that has to be taught, learned, and understood. Again, you may not ever be interested in learning from me, but those who learn from me, they sit through a live class. There's now a home study program where you can listen all you want. We get together and meet twice every 6 weeks in what's called a practical application and review day to take the trades that I do and show people how they relate exactly to what it is that I teach, how what I teach relates to what I do, to bring out exactly how when you're learning in class, you may kind of understand it, but when you see it on chart examples, I get together with people individually who need help to keep learning. We scan together some nights, and it's a constant commitment by me to get you to learn. I am committed to doing this for people who want to learn. I'm very proud of a lot of the students that have come through. My favorite student is somebody who's never been in the market before. They're the best or fairly new to the market. They learn the best. More difficult are people who have been involved in the market for a long time, or who have even been brokers or whatever. Those are very tough people to train. By the way, I've trained 2 market makers how to trade. Market makers are not good traders. What they do is not trading. Making a market for a stock has nothing to do with trading, and market makers are not good traders either. They're difficult to teach as well. What I hate is people who come and talk about stuff, because I listen to people, and then don't show you examples, don't show you what they do, show you a theoretical system, and or just show off a couple of good things. So what I want to point out is, yeah, those were a couple of nice trades. I showed them to you because they were the most recent trades. But in general, this is the long-term trader results. So sure, I have some stop outs. The stop outs lose 1 risk unit, whatever that is for you. If you're risking $1,000, you lose $1,000. A lot of the winners, I'm averaging almost 4 times 4. We call it a 4 Sharpe ratio for those that understand, but about 4 times the win than the loss on average throughout this year. So the results are there, they're good. That's over, I think there were 30 trades this year. So it's about 3 per month. And if this is something you like, you just follow along. You don't have to be taught anything. You take your own account, you get an email, you get a text that tells you you have an email. It's long term, so it's usually not a big hurry. Most of them are entered during the day though, so you'd have to be able to pull out your phone at work if you work and enter the trades. I do all the management in terms of sending you what the update should be on management. You just follow along. And if you follow along, that's what you get. Day trades. I spend the first 90 minutes, 2 hours every day, day trading. I get together with the trading room. There are people who are signed up. We get together in the room. They follow me. I start talking at 9 o'clock. I'm typically done every day by 10:30, maybe 11 o'clock. Now, again, I hate it when people come and just show off good things. I always use the trades from the last couple, 3 days. So let me be totally honest with you. Monday, didn't like the setups. I had 3 trades. I had a break-even day. Yesterday, I didn't like the setups. I had one winning trade, then I had 2.5 lose. I ended up down 2.5 risk units yesterday. Today's a great day. Today I'm going to be green by the end of the week, and by the end of today, it kind of made up for it. Today we had so many setups, I didn't know what to do with them all. They all didn't work. I wasn't thrilled. I thought I'd make over a week's profit today. I'm not going to do that, but it's going to be a good day. So I'm showing you 2 trades from today, but I just want to be upfront and tell you the last 2 days, I mean, going into today, I was down a little bit. As of now, I'm up again. So I pulled the trades from today because, to tell you the truth, there was just nothing. I just had some partial winners, partial losers, nothing I could even show you. So here's 2 trades from today. And yes, this first one's a great trade. It was the trade of the day. But again, I'll show you the results from last month. I'm not just trying to show off good stuff, generally good, solid trades all the time. This was Z today. I'm not sure if Z is Sealy Posturepedic or Zillow. I think it's Zillow. Daily chart of Z. It gapped down today. This was a gap concept. Now, when stocks gap a significant amount, it's a different world. It's not the usual chart stuff that we look at. You have to understand gap concepts. What I like about gaps is, on sometimes if the market's boring, if it's a tight pattern, if there's not much else going on, gaps are a new world of opportunity, and that's what it was today. The 2 trades I'm showing you are both gaps. They were both shorts. One is short of a gap down, one is short of a gap up. This gap down on Z, here's the daily chart. Here's part of the daily chart. This is today. I captured this about 2 or 3 o'clock in the afternoon. No, well, not 3, 2 o'clock, 1:30, 2 o'clock in the afternoon, maybe 1 o'clock. That's what it looked like then. And this was not what I call a great gap. I want to take you through the thought process a little bit. Some gaps we aggressively enter early in the day. Some are unclear when they may fall, if they will fall, if they may rally. So I didn't have this on what I call my hot list. I wasn't looking at it early at all. You can see the entry down here was at 11 o'clock. So I waited quite a bit on this one. The hourly chart doesn't tell us much here other than kind of help see the extension that we had from the prior day, because we had a big red bar the prior day. I don't normally like these gaps, but being an observer of the markets, part of what you have to do in technical analysis to observe what's happening day to day. One thing that I noticed was that gap downs, just in general, are getting sold a lot more than average. We're in a momentum type market. There's a lot of novice people out there with money that are in there. And when things fall, they tend to keep falling. So I've been a little special asterisk by the gap down. So I kept this on the screen and watched it. And the 5-minute chart here was the key. So we look at the hourly chart. That doesn't tell me much in this particular situation. And then we come down to the 5-minute chart. That right in there is everything. Now, this may be a little bit advanced, and I'm not trying to teach you everything here, but because the gap was uncertain, I need certainty in my entry. I need confirmation. Does that make sense? I don't think I can see you guys type, can I? I always have this problem, but anyways, I don't need to. Sherry will let me know. Does that make sense? So if I'm unsure of the gap situation, I either got to stand aside or wait for a confirming entry. The best type of confirmation, the best type of confirming entry. Oh, I know why I can't see you. Hang on. Oops, nope. I guess I can't access you. Okay. The best type of confirming entry is what we call a failure pattern entry. In other words, if I have a bias of being short, I want to see bullishness fail. I'm not sure if that makes sense to you in just a clean statement like that. But right here is what I wanted to see. So I had this on screen. I didn't short it here. In hindsight, you could have, but I had no confidence it would drop. When it tried to rally here and it pulled back, then we had this kind of lower high through here, a higher low, and this is what I wanted to see. That green bar starting to move up, fail. So right through here is where I got short. Now, got a little bit lucky. It had a great drop, made a lot of money. This just closed out shortly before I got on the mic. So I kind of updated that slide real quick, just barely made it. And so that's the profit from this on a $500 risk today. It was a really nice trade. The last part of it, 4.5 hours. That's a big trade. Don't get them that big every day, but that's what you go for. And what that does is if you have a couple that didn't work that day, you lose 1 hour, it pays for those. Some days you have a few small winners, some days you have a big winner and a couple losers, whatever it is. So this was one really nice trade from today. And the summary of it is here. There's just a 5-minute chart showing you The entry came right in here. Targets 1, 2, and 3. Boom, boom, boom. This is based on a gap strategy. Things change on a significant gap. This is a larger gap, required a confirming entry. Nothing is better to confirm than pattern failure. That was the entry type. I'm very big on having a strategy, a strategic concept, what I call the picture of power. Why do you want to be long? Why do you want to be short? What about this is going to make this thing move? And then fine tuning with specific entries. I teach entries as a separate concept. If you learn a strategy that has the entry built into it, like a Head and Shoulders, you're short under the neckline, you're losing money, I guarantee you. You can't make money doing that. You have to be better than that. You have to be better than the average banana out there, or you're not going to make money in the market. Here's the second trade I want to show you was Lift. Lift was open when I got ready to come on and just closed out. So it's not fully filled in here. Lift was a gap up today. Here's the daily chart, but it was a gap up I wanted to short. I had a very strong bias to short this. This, because I had a strong bias to short it, I didn't need as much confirmation. So this has entered the 3rd minute of the day. So if we come down here, the hourly chart again doesn't tell me much, other than the area I gapped to was somewhat of a significant area right through here. And then we come down and I say, okay, I want a very, very aggressive entry, and that's not pointing to the right spot. I apologize because I threw this out there recently. I got short up in here, a little bit under 51. So it's up in here, the 3rd, 4th bar of the day. It was underneath, see that green bar there? It was underneath there. That's pointing there from the prior slide. So my apologies, it's right underneath there. Short under 50.87. Stop a little more than $1. Got a first target at 49.51, and the rest of this trailed out at 49.12. It just happened half hour ago or something. You can look at a chart yourself if you want. So that made, I consider the goal to make your R unit every day. If you're risking $1,000, $1,000. If you're risking 500, 750, that should be your goal to average every day. So naturally, you want to beat that on some days, which I'll beat today handily, and that helps cover if you have any losing days. So there's a quick little Lift summary. The entry up there was on the inside of this first bar. This is a 5-minute chart. So it's up here on the entry. Target 1, you can see, target 2 and target 3 were question marks because I was not there yet, and we just got taken out of that shortly before I came on. This is based on a gap strategy as well. When things are narrow, choppy days, gaps offer a separate concept to trade. This is the larger gap, but playing against the gap, not as much confirmation was needed because it gapped up. I was shorting it. Don't have to worry about being extended. I have to worry if it's going to fall at all. The entry here was also a minor pattern failure, that little green 1-minute bar. And again, I just want to point out that I'm showing you some trades that are good educational things. Naturally, I try and pick on ones that I kind of like a little bit, but overall, we do really well in the room in general. So they're not just, you know, I've been doing this a long time. They're not just unique trades. Oh, wow, here's a trade or two I made money on. You have to be careful. I just want to warn you. I think most of you probably know. When you listen, there's a lot of stuff that you hear, and there's a lot of ways people can prove things to say, look at this one chart, look at what I picked out for you, look at what I drew for you. And I suggest you just, you know, if you're curious, try out some of these things. Most people go through a phase where they need to look for that holy grail, and they think they're going to find some magical thing that's going to make money for them, as if nobody else in the market would use that if it worked. And eventually people come around to subscribing to the fact that technical analysis is all that works. Now, at that point, sometimes people get distracted. I find that the average person, nothing wrong with this. There's other things in most people's lives than trading. Most people have other sources of income. I think everybody wants to be involved with investing their own long-term money because mutual funds stink in general, and there's not much else to put your money in. Nothing pays interest. So learning the market or following like the long-term trader, I think, is something everybody should be interested in. But not everybody has the time or the inclination to want to day trade to make money. But whatever it is, people I find that go out to try and conquer the market pretty much go through similar steps where they finally decide that technical analysis is the way because they hear people like me talk a fair amount. And then they make a vain attempt to learn technical analysis. They go the cheap way, they listen to some videos, and maybe they sign up for a course and pay some real money. I have to tell you, there's a lot of courses out there a lot of them that will just teach you how to lose money slowly because they're just not detailed or expert enough in terms of what you need to do. A lot of times it's against common sense. If you just want to talk with me, if you want to ask about, how to get educated other places, I'm pretty experienced with what's out there. I can give you a straight shake. There's some people I like. If you don't like me, there's some people I wouldn't recommend, but it can't hurt to talk to me if you want to talk to me. Again, you can follow a trading room, follow a long-term letter, or you can learn how to do it for yourself or do both, whatever you want to do. Technical analysis is the final synthesis of anything you would ever care to look at. It's all those things that are not necessarily wrong, but they're built into price and some quantity. You know how much, you don't know how much without a chart. Finding that moment in time, learning the language of charts. That's what it's all about to me. If you don't get the moment in time concept, you're probably always chasing entries. Monday nights, every other Monday night, I invite everybody who wants to come, just any free member of DTS to come and look at charts together. And I frequently ask if anybody has any questions or suggestions. And I have to tell you, 90% of the suggestions I get are just insanely poor suggestions. People are chasing, I've had people suggest entries to long-term positions that are literally where I would be taking a first target. They're that late. Folks, you have to be better than that. You have to be smarter, wiser, sharper, better trained than the average banana out there. And by the way, you're not competing against big money. You're not competing against market makers. They're trading billions of dollars under asset fund managers and that type of thing. They don't have mobility. They have to expose their hand. Our job is to follow them. Some people say you're trading against big money. That's a stupid comment. You're not trading against big money. You're trading yourself, you're small, you're nimble, and you learn how to read a chart. And that's all there is to it. It's not hard. It requires the intelligence of a fifth grader, but it requires some time and dedication. And if you're not at the time in your life where you're ready to spend a little time, to me, money's not a commitment. This is cheap, in my view. My entire seminar program, you can't, you never get, if you do sign up, and again, I don't want to sell anything here, but if you do sign up, there's one price and you never get charged a penny more for anything, nothing. There's never another thing to buy. You get the full package, and I charge less than what many people lose trading every week. So it's not the price, it's the time. And if you fail at learning to trade, you're not going to spend much and you're not going to lose much money. You're going to spend some time, but that's what you have to invest right now. Don't do it on the cheap. Don't come up and try and learn to trade in one weekend, because it's not how it works. If you have any questions, let me know. I tried to catch up for Sherry there. We have 3 minutes. Three-Legged Stool, love it. You don't care about me. Come visit my website if you want to learn about me. This Friday, if you like what I have to say, I'm doing a 4.5-hour class that you can come and attend. You just have to be a member. Sherry, if you want to pop that out there again for people who came late, that'd be great. If you want to be a member, just sign up. Again, just your email. Don't need your name. Don't need a credit card. If you ever want to unsubscribe, you'll never hear from me. Believe me, I want to email you a lot less than you want to, a lot more than, how do I say that? If you don't want to be a member, I don't want to send you anything, even more so than you don't want to be a member. So sign up for that. Free stuff page, stuff at the bottom, boom. Any questions, anybody? And if you don't get to get a question answered here, again, you can email me. Oh, my email. Boy, do you have that handy, Sherry? You know what? It's Paul, P-A-U-L, at Discipline Trading Strategies. Do you have it somewhere? I can't access it without taking, this is behind that screen I'm showing, so.
Yeah, I'll get it. I'll post it up there for him. Just
Okay.
a second.
Yeah, because there's nothing else. Just email me if you got a question, you want to talk, whatever it is. Do we have any questions, Sherry? Or did I put everybody to sleep?
Let's see. I was sneaking off the edge here, so I'll have to look again.
I knew you fell asleep. I knew it. I knew you were going
Oh,
to.
no, not sleeping, but I did.
You've heard me talk too much.
Care of some other things. Let's see, all.
And whoever's waiting next in line, I was started 5 minutes late, so I'm going to take 1 minute here. That's it.
Paul at disciplinetradingstrategies.com.
It looks about
now
right.
I'll look to see if I can see any questions.
Yeah, if you guys are typing, I can't see it for whatever reason. I wasn't accessed to see your comments.
CRISPR bottoming.
What's that?
Somebody said CRISPR bottoming.
The stock?
Graziano?
Well, tell them to email me because I'm not staring at my
Okay.
charts. I'm on a different computer and that's going to take a while. So email me.
Yeah,
I'll
we're right at the time, but
Okay.
guys, what you're going to want to do is you're going to want to email Paul, and he's not kidding when he says he's willing to talk to you and help you. And look at his page. I mean, you could probably spend a month watching videos, just taking all that in and soaking it in, you know.
Yeah, there's some articles there too, and some other
Yeah.
little quick tips and some other things there as
Yeah.
well.
Yeah, you have a ton of stuff there, and that's really very gracious and very generous. So not only that, I've put Paul's email in the chat. Sorry, my mouth isn't working properly here. Paul at disciplinedtradingstrategies.com.
Yep.
And then you also want, let's see if I got this here. I want to give them the link to the free stuff page again.
Yeah, and once you're there, if you look to the left, you can
There
click
we
on the
go.
home page.
Yeah.
And once you're on the home page, there's different spots. Matter of fact, on the home page, Sherry, is a little square right in the middle to talk about the event Friday, the intro class. So if they click on that, that'll make them become a member too. It'll let them become a member. It won't make them. It will let them because so they can just click on that too, and they'll figure it out. If they can't figure it out, I don't think they should even be trying to trade.
Yeah, you'll figure it out. And then you can also email Paul, and you probably jump on a Zoom and walk them right through how to get into it. But there's a blue button. Click here to schedule a time to talk to Paul. And then also, let's see, you've got to click here for the archives page. Now, what were you talking about clicking about the thing that's happening this week?
Oh, on the home page. If you're on the home page, home.
Oh, I'm not on the home page. I'm on the free stuff.
Yeah, it says click here to register for the intro class.
The top left. Yeah.
Yeah. So it talks about the intro class a little bit.
Friday, November 5th. Okay, cool. I see it.
Right, so there isn't time for it. It's this Friday. And there's no special registration for the intro, guys. You just need to be a member. And when you're a member, you get invited to everything. So that's all you have to worry about.
And membership is free, right?
Membership's free. And you get, and also, Sherry, I don't know if somebody's here that's a member already. 95% is just educational emails, invites to events. Matter of fact, I apologized a month ago because I sent out a couple of sales-like emails because I hadn't done it all year because people didn't even know that I had a trading room or whatever. So you don't get bombarded with crap. You just get information for the most part. Okay.
Well, let me just clarify for everybody on the meeting and everyone who's watching at a later date. Everybody's in business and everybody needs to generate income. So what a person really needs to do is not get offended that there is a sales email, but to take it, and if it's for them, it's for them. If it's not for them, then it's not for them. And there's no point in wasting emotions over it. You unsubscribe. That's it.
Right. That's true.
And, Joseph says, hey, Paul, I'm a free member. Thanks. I'm learning a lot.
There you go. Thanks, Joseph.
So
I appreciate it.
yeah.
But what I will say is I don't have sales ever. We've never had them. So you're not going to get that type of stuff is what I mean. But yeah, you're right occasionally. But mostly you're just getting invitations to events is what it is for the most part.
Yeah.
Educational emails.
I'm just always blown away by the mentality that someone shouldn't have a sales type email. I just don't understand that mentality. Who can afford to do things for free forever and always? Nobody can.
Well, I always felt that, people will come to you when they're ready if they like you.
Yeah.
Exactly. So when they're ready, they come. If they're not ready, they don't come.
Yep. All right. Well, is there those were all the questions that I had right there. Okay. I want everybody to check out your free stuff, go to the homepage, sign up for the November 5th seminar, and then also email Paul or take a chance on setting up a time to get together. I mean, hey, what have you got to lose? It's free. Right.
I'll let your next guest come on. Thanks, Sherry.
Hey, thank you, Paul. I appreciate you. I appreciate you being with us.
All right. Have a good one. Bye, guys.
Have a good day. All right. Hey, this has been a pretty fantastic day so far, and our final speaker is waiting in the wings. I'm going to bring myself back to showing you who we have coming in. We're going to welcome now Price Headley of BigTrends. He's going to talk to us about how to trade options on FB, Apple, Amazon, Netflix, and Google. And he was inducted into the Traders Hall of Fame in 2007 and is the founder of BigTrends.com, which provides investors with specific real-time stock and options strategies and investment education to profit from significant market trends. Price appears regularly on CNBC, Fox News, and Bloomberg Television, and also in a variety of print and online financial news outlets, including the Wall Street Journal, Barron's, Forbes, Investors, Business Daily, and USA Today. Price also speaks regularly to investment audiences nationwide and is a chartered financial analyst, charter holder, and a chartered market technician, charter holder. Thank you so much for joining us, Price. It's been a while. I'm going to make you our presenter. And can we hear you? I see your
Absolutely.
microphone is on. There you are. Hello.
Great to be with you, Sherry. Thank you so much for having me back.
I really appreciate it. You really
Always a
responded
pleasure.
like instantly, and I appreciated it very much.
Oh, my great pleasure. Always a lot of fun to do these, and you have a great group of speakers on here, and I'm pleased to be able to. I assume we're ready to roll, so I'm going to go ahead and get started.
Yes,
Great,
I just
great.
made it so that you could see your own questions, but I do monitor them as well.
Thank
And
you,
then,
Sherry.
do you have, you did give me a link to put out for you, so just let me know when you're ready for it to go into the chat.
Oh, sure. Thanks. I'll get to that stuff at the end. Great to
Okay.
be with everybody here, and hope that you're having a great kickoff to your November. You know, we just intraday had the Fed talking about the markets, and the markets are continuing to respond favorably to the Fed talk, and knowing that they're not going to do a whole lot here. Bottom line is that you need to figure out how you can take advantage of moves that are happening right now. I think what holds a lot of traders back, just philosophically for a second, is that you've got a long-term view of what you think the markets are going to do. And you think, okay, the market's too overpriced, so therefore I'm not going to be buying into it. And to me, that's the kind of thing that holds a lot of people back from a lot of opportunities that are happening right now. And so kind of getting into a shorter term trading mindset to say, I'm only going to be in these trades on these FANG names here for 2 or 3 days typically, and then I'll be right back to the sidelines, back to the comfort and safety of cash, and looking for my next fresh setup. That now all of a sudden frees a lot of people up to say, I don't care if the market's quote unquote expensive by historical means, it can get more expensive, and these stocks can move up a lot more than you or I could possibly expect. So quit missing out, allow yourself to focus on the windows of opportunity. That's what I'm here to teach you about today, and share with you maybe some of what you've been missing on some of the best trading names, in my opinion, in the market today for options traders. Just a reminder that everything I share with you today is for your information and education only. Nothing we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. BigTrends and its team are not responsible for any trades you choose to make, and not all BigTrends products and services are going to be appropriate for all traders and investors. At BigTrends, we don't provide any personalized financial, tax, or legal advice to any individual. What we do instead is we take our FANG options trader research and put it out through real-time email and text alerts to our subscribers' smartphones when we recommend a signal to get in, or more importantly, always when to get out. We never leave you hanging. Do consult your tax advisor before you make any investment that impacts your unique financial situation. If you don't know me, I founded BigTrends back in 1999. So we're actually on our 22nd anniversary celebration this month. It was November of 99 that I launched the company. And it was interesting because, I just had gone through, of course, that bullish phase in the 90s, and then actually called out some pretty bearish stuff in a couple of Barron's interviews, and people thought I was a little bit off my rocker getting as bearish as I did in September of 2000, but as you know, that kicked off kind of a 2-year bear market. So we want to be able to trade both sides of the market. Our whole thing at BigTrends is to focus on trading systems that is data drives it. It's not my opinion. It's not how you wake up feeling that morning, whether you're bullish or bearish. The data has to tell you you have a significant edge, and then we convert that into option strategies as we get these signals on those FANG names. So if you haven't been following the markets for a while and don't know the acronym FANG, we'll talk about that today. We'll talk about how we leverage that with sensible weekly options selections. And when I mean sensible, I mean we're not going to buy way out of the money, really cheapies here. We're looking for names that can give us fairly good bang for our buck of up to a double. And then what I want you to walk away from with me today is my #1 favorite indicator that helps me to see a trending stock in motion intraday. And intraday meaning we're not day trading, but intraday could be at any half-hour bars close. We can say, look, we've got a new signal here. We want to get into this trade on Apple or this trade on Google or whatever it is. And then when we get an exit signal, you'll know exactly how to do that too as we walk you through this. Since it is my 22nd anniversary here this month, I've got also an unbelievable special that's actually the lowest pricing we've ever offered on our FANG program, and a great way to lock it in for allowing you to trade over the next year and couple of years with the specials that we've got at really low, great entry point pricing. But FANG stocks, if you don't know what they are, of course, the acronym comes from Facebook, which, as you know, has renamed themselves Meta for this metaverse thing. And so it's going to be interesting to see how they adapt. Their symbol's still FB for now until December 1st, then it changes. We'll see how the acronym changes. But Amazon, Netflix, and Google, Google's even renamed themselves to Alphabet. So we got a lot of A's in there, especially because we've always said Apple should be a part of the mix. I've been doing the strategy for a number of years. You can always call our 800 BigTrends line and get our full multi-year track record and all that kind of stuff and do your due diligence. I encourage it and want you to be very comfortable with the way the strategy works through bull and bear markets. But these 5 names, as you know, are some of the biggest out there in the tech space. Even though Amazon is more, you could say it's a retail company, but they took advantage of the internet and the ability to go with online e-commerce. They drive almost 1/3 of all e-commerce transactions, which is just a staggering number. That's why Jeff Bezos is the richest man in the world. And I know Elon Musk is coming up on his heels, or maybe passing him with the Tesla surge we've seen. But we're focused on these 5 names here. Netflix, as you know, binge-worthy content. Google, paid search. Facebook, social media. Apple, of course, there's a powerful computer in all of our cell phones to take advantage of. So why should you care about the strategy? Now, again, past performance never guarantees future results. Any one trade to be more or less than what our typical average is. In this case, we made more than our typical average of 100% gain with 171% profit the next trading day. This was actually a put option. This one of the great things about this FANG option strategy for our FANG options trader subscribers is that we don't get complicated. We use the KISS principle, which is keep it as simple as possible. Just buy the option when you want to get in, and when it's time to get out, sell that option. We're gonna take advantage of typically a 2 or 3 day move. This was held over 2 days, but about 24 hours of time. Buy it one day, sell it the next. So we always get into these trades now at less than $10 a contract. What does that mean? It means that you can control 100 shares of Google, which at the time it was trading in the 2,830 range, if I recall correctly. Bottom line, that's like $283,000 for 100 shares of stock. We controlled it for $9.50, which times 100 shares is $950. You control that almost $300,000 of stock for under $1,000. You can see where the leverage comes in with this strategy. The very next day, as the stock drops, since we're buying a put, we're betting on the stock going down. Stock drops and that put option goes up to 25.8. We're cashing it in at 171%. So just on one contract, one options contract, we made $1,600 and change in profit. And then, factor your commissions accordingly, which is on a one contract trade. You shouldn't be paying more than $1 for an options contract with no ticket charge these days. That's one of the greatest things in my 30 years of plus of options trading is the broker price wars a couple of years ago that have brought all the prices down so dramatically that you keep most all of what you earn in your options trading. It's really a beautiful thing now. So again, past performance not guarantee the future. It could be better or worse going forward than it was in the past, but we've had a lot of success with this strategy. So I want to share with you what we were seeing. How did I find this trade? And show you a bunch of different examples here of what we're looking at. Now, when we got into that trade on Google, the stock was going down right here. This is back, I was on September 17th as an example. What we have here on this bottom chart, the main indicator that I want you to kind of take home and study and play with on your end, on your chart platforms, because it's available on just about every major platform here. ADX, okay, that should be a D. ADX in green here. This green line, we want to see it going up. It's called average directional movement, developed by a guy named Wells Wilder. We'll get into that a little bit. But what we're looking at is that the stock, you can see, is breaking down below some support up here. This black line is a moving average filter we also use to say if we're going to get bearish, it better be below that average, which you can see it was just breaking that average earlier that morning. And so as it's just starting to get going here, we want that ADX to be turning up from kind of a low level and crossing up. These directional movement lines are saying the red line's the negative directional movement, meaning the net new lows, they're going down, right? So you're getting more new lows. How many new highs are you getting through this breakdown phase? Not many. Thus the positive directional movement in blue is actually dropping, saying you're not getting as many new highs. What happens when you get lower lows and lower highs? That's called a downtrend, right? So the ADX trending up is what we want to see. Once that green line rising and continue to rise, you see that, look what happens as it drops over that first day, we're making some money, but look at the next day's gap down. Thank you very much. We're past our 100% double target and we're locking it in on that gap down. We can just get the windfall above our 100% profit and say, take the money and run. In the old days, I would say wait for the ADX to roll over. If it does roll over while we're holding the trade, we would get out there, but we're already out at past our profit target. And so we don't want to let that slip away, because a lot of times those reversals after an extended move can be dramatic. Notice, by the way, if you're kind of soaking this in, these are TradeStation charts. You don't have to have TradeStation. We like that as one of our favorite platforms. But there are multiple platforms that have this ability to see the ADX in motion. I'm using a 30-minute chart here in the top left, and I'm thus getting about a 2 to 3 day trade window where ADX will be more stable than bar by bar price action. That's why I don't like people that tell me they just use price action. I say, well, let me get you a whiplash, a neck brace for the whiplash you're going to get with all the head fakes. Because even on this trade in Google, right into the close, you see it was reversing up there into the close a little bit, and people might have panicked and said, uh-oh, momentum's not down anymore. It's starting to flip back up. And you say, okay, well, you would have missed that big gap down and left more than half of your profit on the table if you sold it out into the close that first day. So don't get cold feet with this. You want to trade with risk capital that you can afford to give it a chance to let it do what it's going to do, whether it gets to its target, to its stop, or anything in between. We'll usually stop these out somewhere in about the 30% loss range. And we also are really good at trailing our stops. So once we start to get some profit, you'll see us move our stop up to break even. Once we start to get a better gain, we're not at our full 100% gain yet, we'll move the stop up into almost an assured profit if it comes back down, type of a thing. So that's a bearish strategy with a put option. Here's a bullish one coming up. Another Google example using call options, which of course are a right to buy the stock to get more valuable as the stock goes up. So when you're buying a call, you can see here with Google, with these high dollar ones like Google and Amazon, we've got to go out of the money to keep them at $10 or less, or $1,000 or less invested per trade. We base all of our portfolio tracking off of no more than $1,000 going into a trade. And a lot of times with our FANG traders, we'll say, hey, just even use just one contract going into each trade, because a lot of times they'll be somewhere between $5 and $10. So $500 to $1,000 still would get you just one contract and not two if you're keeping your risk at $1,000 maximum per trade. Even if something went haywire and it gapped way against you the next morning, you know that you can limit your risk by buying just that limited amount per trade. We don't do this strategy, by the way, right in front of earnings. We avoid the earnings weeks because the volatility jacks up, and we want to typically trade this without that kind of volatility jump in the earnings weeks. So it's another just risk management thing that we prefer. But you can see this one's kind of done choppy, not much happening. It's been chopping around that long-term filter line there. So we just say pass on all that, put big X's through it. We don't want to trade that. We want to trade when this like everybody sort of lost interest and now it's starting to break out again. We're getting in right into the close of that bar right there. Notice that the stock's trading about 27.70. We're buying about 90 points out of the money, but put it in percentage terms. From 27.70, that's like what, 3.5% out of the money. And you can see as the stock makes a move up, not even to the strike price we bought of 28.60, it gets up to about 28.10. We got our double just over a couple of hours, right? That's from the morning of August 23rd, and by noon we're out. So from about 10 a.m. to about noontime, we're saying thanks very much. We'll take our money and run. Now that's a day trade. We don't want to day trade a bunch because we have a number of people that say, yeah, they're starting with smaller accounts. They don't want to be labeled as a pattern day trader, which would require you to put in 25,000 bucks to keep actively day trading. That's not really our game. We get a lot of people that can start this with as little as 10 grand or less to get started per trade. But the key is that, we want to typically say if we get that double, let's take it, but we just will make sure we won't do more than 3 day trades in any 5 consecutive day spans. You don't have to worry about that day trading rule noise there. So we're always sensitive to that. Bottom line is that you can see it just caught that very quickly, and then we're able to take the money and run. But again, sometimes they take a little bit longer. And part of this is due to the type of options we buy. So we're not just buying out of the money options. With Apple, for example, we're able to go more in the money. So we still will keep it in that higher dollar, like $7, $8, $9, no more than $10 range. With this Apple example, we bought a 123 call. It's back in January, about the 123 strike calls. Look at where Apple was trading. This actually shows the ADX now in yellow and just crossing up here right as it barely crossed our filter line. If it hadn't been above that filter line at the close of that half-hour bar, that was a 10:30 a.m. Wall Street time close, second half hour of the trading day. If it hadn't closed above that, we would have just passed on the trade. But instead, we're getting in there. And remember, the stock's trading about 131. We're buying a 123 call. What does that mean? It means that we have a right to buy the stock at 123, good until that following Friday, January 29th in this example. We bought on January 20th. So you can see we have usually about a week to a week and a half on these trades before they hit their expiration, and we're going to be out well before the expiration day. So the point being that, okay, we're buying an in the money option, $8 in the money when the stock's at 131. That means the time portion of this $918 we paid is only about 118 bucks of that 918. So it's basically about what, 13% or so, and that's about 87% is intrinsic value, only about 13% time risk. So if nothing happened and it stayed dead flat at 131 into expiration, your option's still going to be worth $8 if it never moves at all, if it just flatlined on you. But of course, we're betting that's going up. And of course, this is what I call a stock substitute strategy, because now you've got very little time risk and you get great leverage as the stock runs from 131 to our, you can see it made it up to about the 137 area, give or take. And you can see just under 138. We're seeing the stock thus rise, what, about, in this case, maybe, 6%, no more, maybe 5%. Bottom line is that we made 60%. More than 10-to-1 leverage on a very relatively safer option strategy, buying the more in the money. Now, Apple allows us to do this. A lot of the other names have moved up so much that we have to buy a little bit either near the money or with the Amazons and Googles out of the money, because even Netflix out of the money, because they're so much higher priced stocks. The key is we're not going to hold them that long. If that ADX rolls over like it did here in this example, that's where we're hopping out, when that ADX bends down at the end of any 30-minute bar, even by the slightest amount. So it makes it really simple. You can see in this case, it kept going, and I don't care. I'm happy to book the 60% gain, move on to the next opportunity that's a fresher, better reward to risk situation. Once that ADX rolls over, it opens up a lot of uncertainty for reversals, for chop. It's not that strong trending phase. We're going to talk more about ADX and the concept of what's behind it. But one of the things I love about ADX, here's another Apple example, October 9th. When it's starting to cross up right here, we're buying into the calls. In this case, we're buying with the stock near 116. We're buying a 107 call, about 9 points in the money. We're paying $972 to control 100 shares of stock. So 100 shares of stock would cost you about $11,600. We're controlling that for under 1,000. And more importantly, our time portion of this trade is only about 72 bucks out of that 972. So less than 10% time risk. People would say, why would you buy it into the old highs? Why wouldn't you wait for the breakout here? Because if you wait for the breakout and buy on the next bar's open, now it's gone from 116 to 120. Our eventual exit here is going to be around 124. 4-point intervals, right? You would give it up 4 of your total 8 points of that move, give or take. So you give up half of your total move. I believe the ADX shows the structure change from a trading range or uncertain price movement structure into as we cross up above that declining directional movement line. That tells me that we're getting into ready for a bullish breakout here, and I want to be on board before everybody realizes the next morning. So the idea is that we would send out a real-time alert there at about 1 o'clock in the afternoon on that day on October 9th and say, buy these October 107 calls up to a set price. And in this case, never more than 10 bucks. So our average entry here was 972, and then we got 75% the next day. Almost got our double, didn't quite get there, but as it rolled over, even before this ADX rollover, we have a profit protection rule. And so that profit protection rule is tagged as it comes off that high and says, okay, now it's less certain what's going to happen next. Let's take the 75% and move on. Facebook, as we said, changing their name to Meta for trying to take advantage of the metaverse theme here. But bottom line is that you can see this is a more classic price breakout. We've moved through the old highs. We're buying into the close of that bar there. Stock's trading about 257.5, and we're buying a 252.5 call, about 5 points in the money. This has a little more time value in it, but it also had a little more time until the expiration. So essentially saying, okay, we were in it on the 6th, we're out of it in less than 24 hours the next morning on the 7th and got our double target. Okay, now we're a little early, it goes a little more, and then by the time it rolls over, again, you're glad that you're out and not having to worry about it. The ADX flip was about there. Similar price levels, maybe slightly worse on the ADX flip, but of course you've lost a little bit of time as well. So at locking it down when you get the bird in the hand of the 100% gain has really been our strategy. Tate asked about a minimum open interest. The beauty of all of these, Tate, is that they are some of the most actively traded options in the entire U.S. stock option space. Okay, so of course, Apple is the biggest name out there on individual equities, and so the point being that in the U.S. that we're focused here on names that we know are going to have a ton of open interest. We also know that they're also going to have a lot of daily volume, and the spreads are going to be relatively tight between the bid and the ask. So it's not us against the market makers, us against a lot of other traders. And that's why we just have supreme confidence in the liquidity of ability to get in and get out very easily. So you see this, how this ADX combined with the DMI lines is really a secret weapon for me. But what is DMI and ADX? In a little more worded detail, DMI stands for Directional Movement Index. Wells Wilder, one of the true trading technical analysis giants of the industry, he invented a lot of other indicators, including RSI that I'm sure you've heard of. He said on this particular concept that he was focused on that a lot of people talk about the high-low range for the day as that stock's range, okay? And he said, well, the true range for a stock should include the amount of a gap, if any. So when you look at your classic kind of open, high-low, open here on the left and open, high-low, and then close on the right for a given day, and say the next day you get a bar that looks kind of like this. Most people would say that second day's range, we'll call it a little R, is that high-low range. And Wilder would say, hold on, not so fast. Go back to the prior day's close with the gap up. That functions almost more like a low. And now your true range, TR we'll call it, looks like it's almost double what that second day's high-low was of that range, right? So the true range incorporating the gaps actually shows you more total movement price action-wise than just looking at the high lows day to day. So the gaps matter in Wilder's calculation of true range, and then you can average that out over a period of look back bars to get what's called the average true range, or ATRs, that show you how much stock is moving over a given look back period. So you start to see the stocks that are really zooming, the ATRs will start rising. Stocks that are kind of contracting, not much is happening, you'll see ATRs start to settle back down. So it starts to give you a feel for where that potential is for movement, and so that net new movement, whether you're getting higher highs and higher lows, that's the definition of an uptrend. That's where that positive directional movement will be above the negative directional movement. That'll start to pick up that the ADX is starting to rise, and that's what we want to trade here. So we want to trade trends. We want to stay away from ranges or range oriented trading strategies. So you don't want to, something goes up, you don't want to say, therefore I should sell it and bet on it coming back down. It's basically saying you're looking for that kickoff phase of it going up to say that's going to create more institutional demand to want to be a part of that trend. Institutions are just like you and me in that they want more of a good thing and less of a bad thing. they are the ones driving the market more than you and I are. So let's focus on, okay, that they can get liquidity, they can move money in and out of these FANG names, whether through stocks or options, very easily. And so therefore, you're going to see a lot of interest in these, what becomes self-sustaining trends. When you look at ADX, ADX is essentially saying what's the kind of combination of things that we're seeing with the positive directional movement, the net new highs going up, we're not getting any new lows. That's going to, the gap widening between those DMI lines, the plus and the minus, is what's really going to pull ADX up. So then you can create a percentage kind of to get a similar range between different stocks between 0 and 100% to tell you, okay, well, how much kind of directional movement are you really getting and trend movement are you getting? So let's look at some other examples here. So here's another bear example. Again, atypical because a double is usually our profit target. This was an Amazon play that we had where we got bearish on it. That was prior May 31st. We can say we're in the negative category. A lot of people would say that the real criticism of ADX is that if it starts rising, sure, it tells you that it's a trending situation, but it doesn't tell you in what direction. Well, I can tell you that's why I overlay the DMI lines on top of it and say clearly the negative movement is expanding, the positive directional movement is getting less and less. That's the sign of a start of a downtrend. Also that we're below our moving average filter. By the way, when you become a subscriber for any length of time, you can get our settings and our rule sheet to go in and pop those same settings in on your trading platform and follow along just as we do. So we'll call out the real-time email and text alerts when to get in, when to get out. So when we called this one out, this is back before we switched back to $10. We used to go up to as much as $15 or $1,500 a trade for a $15 option, control 100 shares. So now we would buy a little further out of the money to get it down to 10. But basically in this example, you see a 1,745 strike put when the stock's 1,780. You can see on that point here, that's where we're getting bearish. Right in that first half hour's close, that's where we're seeing that signal that Amazon's poised for more downside. Now, you think, oh, well, I've missed it. It's already gapped down that first gap. That gap creates opportunities. But notice, if you see that gap, you get into a put trade, you're betting on it going down, and then it goes up, it goes sideways, it goes maybe a little bit in your favor into the Friday close there. You're not going to be making much money in that first day. So this is where the ADX guides me to say, you know what, ADX is still rising here. As long as that green line's still rising, I want to be in position to take that trade on through the weekend and see what happens on Monday morning. You see it gaps down. As we're getting the alert out to take the profit at a double, it's plunging so hard and fast. Look at how fast it goes from 1760 to about 1700 in a matter of minutes. By the end of that half hour, it's lost, as you can see, 60 points. And so as we're getting filled, there was some delay from our broker confirmations that we were getting filled at even better prices than what we put it out at. That was more than a triple. Not typical, but we say, look, even at a double, we'd be happy for just over 24 hours in the market, not counting the weekend. So of course, market time that next morning after getting in the prior morning trading wise. So think about that. You say, well, gee, you could have made even more money by the time ADX rolled over here. You see it's gone even a little bit lower. But our view is that, okay, that bird in the hand is worth that two in the bush, because you'll see a number of times where it can, especially on bear trades, where it can reverse against you very quickly if you're not careful. So we like to take the double when we can get it, and if we can't, we've got some rules how we process the trailing stops going forward. Here's a Netflix kickoff. A lot of these you see are happening right off the first half hour, right at 10 a.m. A lot of people would say, holy cow, it just popped from 345 to 355. It's moved up 10 points in just a half an hour. That's something that looks too extended. I'm not going to take that trade. That kind of thinking will cause you to miss some of the best trades that are out there in the market, because what you really have to look at it as actually a kickoff point. And how can we be confident it's a kickoff point? Because ADX is coming from a low level where people had previously lost interest. You can see certainly over the prior session here, nothing happening in this prior session or two. ADX drifting down is almost a sign of the lack of interest that's going to develop because the thing's been going sideways for a while, no clear trend. You know how you feel when you're in something and it stops trending on you for a while. You lose interest. You say, I'll move on to something else. Then you go back and look at it later. If you stop looking at it and you go, holy cow, look at the move it made once it started trending again. So the key for us is that we get that ADX moving up from a low level. Some people say trade ADX when it gets over 40. No thanks. You can see you would have given up more than half of your profit potential if you wait for ADX to get over 40 or even 30. So the point is, we look for that kind of kickoff initiation of the trend point, and then we didn't quite get our double, and as it rolled over right in here, you can see the ADX rolling down. That's causing us to get out at an 85% gain the next day. So that $905 invested turns into in the neighborhood of about an $800 profit. So so you say, okay, what are weekly options? Every Friday is now an expiration Friday. So as we said, these FANG names have tremendous liquidity. If you're looking at a 4 Friday expiration month, set of expirations in a given calendar month, or sometimes you have 5 of those, like in this chart, every one of those Fridays would be a potential opportunity. In the old days, the 3rd Friday of the month, that last week of that 3rd Friday is where I would do the strategy before weekly options came out. Now we get like 4 to 5 times as many opportunities to do this week after week after week throughout a given year. You're going to have tons of weekly opportunities with our system, typically about an average of about 6 to 8 a month. So somewhere in the neighborhood of 80 trades or more a year. Now, when you look at this, you say, okay, when we can focus on this shorter term expiration, knowing that, hey, if we've got an expiration coming up this Friday and in a couple more days, we're not trading that right now. We're trading next Friday's expiration, the November 12th expiration for new signals that we get here over the coming couple of days. So the idea is that we're not trying to take it to the razor's edge of the expiration day, but we're trying to take advantage of, you pay a lot less time premium. And we just, as I said, we stay away from earnings reports. So that's the one thing that, we don't want to do with this strategy. We want to say, let's focus ourselves on where there's really the best of the best type of opportunities outside of that kind of a gap risk situation. You can do it with ETFs and indexes too, but bottom line is that, it's all about knowing where the odds are in your favor. These high ATR stocks, per the Wilder average true range concept, can really substantially increase your profit potential. And it's even caused me to adapt my methods relative to how I used to trade when I was getting ready to launch BigTrends. I would always focus on super high delta options, like an option like a Humana example here on the right, where it's a $300 stock. You buy the 292.5 call, it's 7.5 points in the money. You're paying just under $2 a time. You got a really nice high delta. Delta, if you're new to options, means that stock moves up a point, that option should move above 80 cents on that dollar for the stock. So stock goes from 300 to 301. What's your option contract go to? It goes from 940 up 80 cents to about 1020. So then, of course, it's a 1/3% move, and the stock gets you about in the neighborhood of a 9% move in the option. So that's where your leverage kicks in. But the key is that the daily ATR on Humana in this example is only 2.25%. So if you go over and look at Netflix, a similarly priced situation, the options are a bit more expensive. You can see it's on a 327.5 5 point in the money call, you paid 9.5. So it's almost a 50-50 intrinsic in time situation. Your delta is only 60%, give or take. So aren't you taking on more risk there? You are. But look, you're getting almost twice the ATR percentage move, 4.25% versus 2.25. So when it makes a 1 ATR move in this last row here, you're getting almost a 90%, 89 2/3% gain in the Netflix example. For Humana, you're getting just under 58% profit. So you look at what that is as a multiplier, that's like more than 1.5 times more profit per ATR with a Netflix example than with the Humana example. So it's made me, understandably a little more proactive to say, yes, I want to trade those names that can really move if I have a trend edge. The caveat to this is that if you don't have a trend edge, if you're not good at trend following and you're on the wrong side of it, it could probably have that same 1.55 times risk if it goes against you instead of for you, right? So you need to know that you have a directional advantage over a large sample of trades. So that's really, really valuable here. That's why we put so much energy into getting the right system that's going to give us the best trend edge that we can use for this high ATR stock strategy. So here's a great example with Netflix and the speed of movement. Again, look at this prior phase before the breakout. Even you can see where the opportunity is here. But if you're trading Netflix before this breakout, you're getting chopped up. It's flipping back and forth. Nothing's happening. ADX has not turned to the upside with enough conviction yet. The conviction is where it starts to cross that declining directional movement line by the close of that bar. And you say, sure, we're going to leave a little money on the table to get some proof, some confirmation that this thing really is moving more dramatically. So we're waiting till about 5:10, and then you see we're buying the 5:25 call. And just over the next, you can see maybe 3 hours, 3.5 hours, from about 10 a.m. up until about maybe 12:30 to 1 o'clock, the power lunch hour there. You can see now we've moved up from, as we said, 510 up to what, about 535. We've gone from out of the money by 15 points to in the money by 10 points in about 3 hours. So that 846 at $8.50 has now gone up to our target at 17, and we've taken that just hair over 100% gain in that same day. Again, a hair early, but again, if you wait for it to come down into the next day, you're taking on more gap risk, you're taking on more time decay risk. It's flipped back down slightly against you. So why take on that risk if you can take that bird in the hand and go ahead and then keep compounding those gains over time? So you can see, just like in this example, that one Netflix call option trade put 848 bucks or so in your pocket. And in this case happened in less than 24 hours, in just a few hours. But we tend to say 2 to 3 days is your typical kind of like a fast swing trade approach here. So to me, once you start to, if you've had trouble like trading these momentum names, especially these are the most active big cap names that still, I was worried that they would get too slow once they got this big. They're still such a primary source for institutional trading activity. You really need to add it into your portfolio of choices of how you trade options. To me, I mean, it's just I always say, I like you to be diversified across multiple strategies. If you're an options trader, don't just do one thing. Try to get several different things going, because in different markets, sometimes the straight up buying will work the best. In other markets, sometimes credit spreads will work the best. I don't want to put all my chips in one basket. I want you to diversify. You should want to diversify too. But you see, the beauty of this is you only have those 5 stocks to focus on. Okay, we're not worried about anything other than those big 5 FANG names. Simple buying of calls and puts. You could do it with as little as 5,000 bucks in an account, or breaking out a part of your account to just say, kind of, I'm just going to mentally say, okay, got a bigger account than that. I'll just put 5,000 to get started, and just don't do too much on any one trade. We say less than 10 bucks a contract, so you can get at least one contract on every trade, for up to $1,000 committed per trade. How long will we be in? Anywhere from the same day to 3 trading days. It's that active swing trading here. We can send them at any point during a trading day, but you see a lot of those trades came out in the first half hour to hour, 10 o'clock or 10:30 Wall Street time. We need that first 30-minute close to be behind us. We won't buy right at the open. We need to see what happens by the 10 a.m. first half hour's close on any new signal. You can also get them via text notification. I highly recommend that, because it's the fastest way to get the trades in addition to the emails being sent out. New trades, we'll say up to about 8 trades a month, and no more than 2 open trades at any point in time. That's important for those of you that are using maybe smaller accounts and don't want too much capital committed at once. So we're not going to load you into all 5 names at the same time. We'll pick our favorites, and then we get you in. More importantly, we get you out. We tell you with specific follow-up strategies, where to put your stop loss, where to put your profit target, how to adjust the trade, and then we give you a lot of educational resources on our members site. So now, if you were buying this straight off of my website, you know, just the settings and rules would be like $197 value. You get a weekly video update from me, which over a year would be like a $500 value. Over what we're going to offer you here, we're going to actually take a year, we're going to double it. We're going to give you 2 years of access here with this 22nd year anniversary special. That would be like $2,000 a year, or almost $4,000 for 2 years worth of trade alert access, over up to about 200 trades over 2 years. Still a great value there, but that would cost you $4,600 and change. I'm saying scratch that. I'm saying, you know what? Being in business 22 years, having launched BigTrends in November of '99, I'm in a celebratory mood, and I'm taking it down to $422 all in, getting my rules and settings, I ask you just use it for your own benefit, of course. That's part of my terms of service when you sign up. But you get the weekly video updates with the training on an ongoing basis, and you get the real-time entries and the real-time exits on every trade, all in for the next 2 years of access, just $422. It's pretty insane value, but if you go to this page here, you'll be able to lock it in for this very short window here. And notice it's a members.bigtrends.com site. Sherry, appreciate you posting that for me when you get a chance. Members.bigtrends.com. Thank you very much. Members.bigtrends.com/FOT for FANG Options Trader, FOT24. So members.bigtrends.com/FOT FOT24. We do have a 3-month offer for just $197. That's still a discount of our usual 3-month pricing, but obviously you're getting 8 times as much time for just barely over twice the cost. Why 422? Because I've done it as low as 497 before. I'm taking it down even more to 422. It will not go lower. It's a 22nd anniversary year, knocking it to just a 22 at the end there. And quickly, if you wonder what alerts look like, and I'll go back and show you that offer page here in a second. But alerts look like this. Here's an older one, purposely sent older so you won't get confused with something that might be open right now. Bottom line is we call out the trade buy to open. This was a Netflix example. We tell you which expiration, which strike price, and the symbol spelled out there. And we tell you up to $9.20. That's $920 to get one options contract controlling 100 shares of Netflix for up to and no more than 920 bucks. You can see we called it out. It was right after the 11 o'clock hour Wall Street time, and said when to get in. And then we sent a follow-up right after we got filled and said, okay, we're in. Now we'll put our first kind of disaster stop in here. We don't expect it to go that low, but we'll say we'll put a disaster stop in because we got in for quite a bit lower. I think we got in at 880. So we'll put a stop at 440 just to get it started. We know that if the ADX rolls over, it'll usually get us out way ahead of that. But basically said our target here is you take 880 times 2, you're at 1740. So we got in below that 920 at 880, and we just take the full, we don't take a partial off at a double, we take the whole thing out when it hits a double. So it's just really, really simple, clean and easy instructions. And you just have to go to that members.bigtrends.com/FOT24 site. So you get all these things, by the way, and I want to allow Sherry to finish on time, so I'll wrap it up with this, but just you get all these pieces. I'm a big believer in learning while you earn. So you're constantly learning about the ADX system. You're able to follow along when you get our settings and rule sheets, plug it in on your side. If you have questions, we stand by at our 800 Big Trends number. And by the way, you see that when you go to that page, it's a really clean and simple order page. So the beauty is if you got questions on it, we've got our 800 number down here, 800 Big Trends. I'm a big believer in keeping it simple, or you can email clientcare@bigtrends.com. We are here to help. So just review the terms and conditions. Like I said, been in business 22 years. And frankly, I've traded for over 30 years, and in my time in the options game, there's never been a better time to trade, because with the commission reductions, with the cleanness of these signals, and with the liquidity getting in and out so easily, not worried about getting stuck in a trade, and knowing that we're your eyes and ears and fingertips to send you this information and get it to you, we're always going to be monitoring it, never leaving you hanging. There's just not a better way to go to help you learn while you earn with this package of educational components and the trade alerts in and out. Thank you, Long, for your very kind words. I'm glad you called it a great presentation. It's very kind of you. Always love that. Sherry, I don't know if there's anything else we need to talk about to help you wrap it up, but I want to give you a big thank you for the opportunity to share this with your audience here today.
This is such a phenomenal offer. I think everyone should give it a serious look, if not just go on and get it done, right? Because,
absolutely,
man, that's fantastic. I really appreciate you being here, Price, and I cannot wait until you can come back again. And I thank you for finishing right on time.
My great pleasure. Thanks for having me, and look forward to seeing a bunch of y'all in the FANG Options Trader. I know you're going to love it, not just for the next year, but for the next 2 years worth of access. Like Sherry said, that's a phenomenal value for thousands of dollars of value for just 422 bucks. One-time investment, no future billings. You lock it in, and you're good to go for the next 2 years. Thank you, Sherry, and trade well, everybody. Hope to see y'all soon.
Have a good day.
Take care.
Bye-bye. All right, there it is, folks. We have gotten to the end of our day. I hope you'll join us again in the future. Our next webinar is November 17th, not next Wednesday, but the Wednesday after. This has been a presentation of Traders Exclusive. You can find us at twitter.com/options_info. And of course at tradersexclusive.com. Please be sure to check your email for the link to the replay, and then also from the presenters here today, they will be touching base with you. And I would like to thank all of our presenters for joining us today. It's, you know, when it's not a big event, it's probably harder to keep it as a top priority. So I very much appreciate everybody coming in on time and everybody being done on time. And I thank you all for attending. And this is your host, Sherry, and I also am saying trade well. Bye-bye, folks.